Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Live from New York City, welcome to the program. It is Payrolls Friday. We're looking for something like 180,000. That's the median estimate in our survey. Equity futures going absolutely nowhere going into this print. The equity market yesterday also totally unchanged, virtually at the close. In the bond market, yield higher by a single basis point, 429.86. Plenty to discuss over in Europe at 108.91 on euro dollar. Under surveillance this morning, a hawkish cut.
Despite the progress over recent quarters, domestic price pressures remain strong as wage growth is elevated and inflation is likely to stay above target well into next year. We are not pre-committing to a particular rate path. We will continue to follow a data-dependent and meeting-by-meeting approach.
So here's the latest. The ECB maintaining a hawkish tone after yesterday's 25 basis point cut. Isabel Schnabel doubling down on comments saying the bank cannot pre-commit to a particular path. Win Thin of Brown Brothers Harriman writing, quote, the euro relief rally will be limited, with the Fed likely to deliver a hawkish hold next week. The monetary policy divergences will continue to widen. Win joins us now for more. Win, wonderful to get your perspective on this program. I do want it on one particular point of view you have. The divergence can continue. Question that sort of Lisa and I have been throwing around over the last week. What divergence? How far can this go?
Well, divergences are not as wide as they were, say, 3 to 6 months ago. I do acknowledge that the Eurozone downturn wasn't as deep as I expected. It was pretty shallow. But by the same measure, the recovery is going to be also very shallow. We're not going to get a huge burst of growth as one might expect from sort of deeper sort of V-shaped recession. So, I think that we'll know more today, obviously after the jobs data, and next week after the FOMC CPI data. But to me, the ECB is pushing back very hard against sort of pre-committed path. But it's pretty clear that with the way the data is coming in that they will most likely cut again in September and December. So we've got 3 cuts already. This is, to me, quite unusual that the ECB really front ran the Fed, and they're cutting earlier and cutting more than the Fed. So I think that's what I mean by sort of widening divergence. And certainly, on an economic perspective, the U.S. is still growing, somewhere around 2% in Q2. The Eurozone is barely growing. I think 0.2, 0.3.
Well, Win, as you know, in the 20-plus year history of the European Central Bank, it's not just rare, it's unprecedented. They've started to cut interest rates. Let's just deal with Europe a little bit more. Why do you think they will go again in September and perhaps again before the end of the year? What do you think is going to drive that? The growth backdrop hasn't been great, but it's at least starting to turn a little bit higher over the last few months.
Absolutely. I think I'm reading between the lines. There's several theories, I think, but mine is that they are more concerned about growth. Again, I noted earlier that the recovery is likely to be shallow as well. And I think there's been some relief that the data have started to turn, but I would note that, for instance, Germany's biggest trading partner is China. And as you know, I keep sounding like a broken record here, but I remain very negative on China. I don't think it's going to be a really huge sort of addition to global growth this year. I think really it's still the U.S. is the only game in town. So I think the market is getting a little bit overly bulled up on the Eurozone story. I think when you, again, read between the lines, look at sort of the trajectories, I think the ECB is concerned.
Would you say the same thing, Win, about the United States and the Federal Reserve?
They are, at this point, focused purely on their inflation mandate. We are basically at full employment. So at this point, they have the luxury, and I know many times those two mandates are sort of at odds with each other. But right now, they have the luxury of having one mandate pretty much checked off. Their sort of unofficial mandate is financial stability. You can check that box as well. So that is why they I think, are single-mindedly focused on inflation right now, and rightfully so. Mr. Powell is a student of history. They do not want to cut too soon, have inflation start to go up again and have to take back that cut. It's, again, they've been counting patience. We had a very dovish hold back in May. By the way, I'm having trouble with all this new terminology. Hawkish cut is something that's very new to the new lexicon. I'm still having trouble saying those words, but here we are. Anyway, look, I think divergences are rising everywhere. It's not just monetary policy; it's economic. We've seen that in developed markets. Swiss National Bank was the first to cut. ECB is the fourth, I think, central bank to cut ahead of the Fed. Many EUM central banks started cutting back in 2023. So I think we've been lulled into a sense of complacency. I think divergences in general will widen in the coming months. To me, that suggests a potential for greater volatility and greater opportunities for investors.
Well, from what you're saying, it sounds like the U.S. is still on an island itself. And it seems like that would suggest the dollar has quite a bit more to rally. Is that essentially what you're hinting at?
I am. I'm a little less so because sort of the relative story has gotten a little bit less in favor of the dollar. But I have to acknowledge, yes, we are seeing some signs of slowing in the economy. We'll know more in a couple of hours. But the PMIs have been mixed. We had some weak manufacturing PMIs, but the services for May was blockbuster. So I think the economy is slowing, but there's still pockets of strength. And again, inflation remains elevated. We'll know more next week when we get the CPI data. But again, the Fed has the luxury of being in a strong position that they can hold off, be patient, and see how things play out. They're not dealing with a recession or economy falling off a cliff. As long as jobs are being created, that people are spending, the growth remains supported.
Can you explore something with us? Just quickly, I'd love to do this with you. We mentioned this yesterday. Can you imagine if the Federal Reserve cut interest rates and at the same meeting raised their expectations for inflation? Can you sort of envision what the market fallout would look like that day if Chairman Powell tried to do that? We talk about Powell sort of having the luxury of waiting. Why does he have so much more pressure on him in this moment? I didn't feel that in quite the same way on the ECB yesterday. Their ability to deliver a cut and simultaneously raise the forecast for inflation, I don't think is an option available to Chairman Powell at all.
No, I totally agree, Jonathan. And it's puzzling. Many clients have reached out and said, look, what's really going on? And again, I have to go back to the fact that they are concerned about growth. If they really were raising inflation forecast and worried about inflation outlook and expectations, they would not be cutting right now. Let's turn us back to what you said about the Fed. Look, as important as the Eurozone is, really the Fed is the big game in town. It's the world's central bank. We have the world's reserve currency. So really, the Fed is the driver for so many rates markets around the world. Again, some central banks are trying to front run the Fed. It's a dangerous game to play. And so far, the ECB has gotten away with it. But I would say that, for instance, especially in EM, all those EM central banks that cut aggressively and cut early last year were faced with currency weakness. Yeah. And that's sort of check and balance on that. Hey, the market said, hey, hold on, you really can't do this that much. You really can't cut this much. And that's sort of how the market instills discipline on many policymakers around the world. And I think we'll continue to see that.
We'll see if the same thing happens. Win Thin of Brown Brothers Harriman. Win, thank you, sir. Pushing back, SMB, Swiss have gone, Canadians have gone, Europeans have gone. Sort of unprecedented here, Lisa, to see this in some of the major central banks.
Yeah, throw Sweden into the mix. So 4 G10 countries have already cut rates, has started this global rate cutting cycle. It seems like investors are on board with this and actually do expect the Fed to join this incredible rate cutting party because you saw the second strongest inflows into global bonds in the past week since July of 2021.
Can you imagine if Chairman Powell did the same thing?
No, it wouldn't happen.
The political blowback down in DC.
It would essentially just be, you're just trying to pad everything for the election. That's how it would be framed.
Precisely. Coming up, we'll catch up on GameStop, delivering a surprise ahead of Roaring Kitty's return to YouTube. More on that next. From New York, this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Two hours away from the jobs report, the scores going into that report look like this. Equity futures going absolutely nowhere. The stock market going nowhere yesterday as well. In the bond market, we look a little something like this. Switch at the board, sit on the 2-year, 473.58, yields up a single basis point. At the end of last month, we came really, really close to 5%. We have backed all the way down since then. We've had a string of softer than expected economic data. Will we repeat that act a little bit later, Lisa? How this bond market is set up going into the data, a little bit different to where we've been in the past.
A week ago, it would have been that it was primed to have a rally, that they would be primed for yields to go lower on any kind of confirmation that we're not seeing some sort of reacceleration. Now it seems a little bit harder. The bar is higher. Even we heard yesterday about this from a number of different traders saying, honestly, it just seems like we've baked in a downside surprise a little bit too much in some of the numbers that we've seen this week.
The 10-year is a great example of that. If you pull up the 10-year yield, that right now currently is about 429, 430. This time last week, we opened up Friday morning at 454. About a big move lower in just a handful of sessions.
Which is the reason why I actually think that what we heard from Michael Hartnett over at Bank of America was really interesting. And Stuart Kaiser kind of echoing some of those sentiments, that if you see a number that sends bond yields materially lower, and materially could be anything from 5 to 20 basis points at this point, that could actually be incredibly negative for equities because it signals the beginning of some sort of more significant weakening. That's the tipping point that I find really compelling on a day like today.
Rate cuts yesterday, negative for bonds. Do you notice that?
Yeah.
In Europe, German yields pushing higher. Euro dollar briefly 109. We're back down to about 108.93. This is what happens when you cut interest rates and raise inflation forecasts. And I know they'd pre-committed to the cut anyway, so it's widely expected, pretty much universally expected. But ultimately, to do that at the same time as raising your inflation forecast, I think yesterday's decision raised a lot of eyebrows, you know, around the city of London, across Europe, and here in the United States too.
There's this feeling that it's deeply personal. I mean, you can feel the personalities in this decision, especially with some of the articles that came out afterwards. You can get the sense of, okay, you pre-committed, you got to do it, go for it. This is a matter of credibility, but give us something. Upgrade those inflation forecasts and say that you're never going to cut again. This is not the beginning of a rate cutting cycle. This is just something you committed to, and you made maybe a mistake, but you're going to move on. And that's essentially the message that we got. So it was sort of this personal internecine battle that you kind of felt come to the fore in a sort of twisted kind of response.
Across the central bank, because it's the staff that come up with the forecasts, and at the same time the ECB president's saying real confident about getting inflation under control going into this meeting. So I can feel the tension too. We mentioned this yesterday, we did it at the top of the show. It's so uniquely European to see it play out this way. Typically with the FOMC, we're trying to work out, is Chairman Powell really reflecting the consensus of the FOMC in the news conference? And then for about a week, you'll just hear from everyone 5 times. And you can work out for yourself. In Europe, you see a story within 60 minutes of the news conference to finish, to work out what everyone else already thinks about it. And basically everyone else is just saying, yeah, July, no thanks, and September, maybe no thanks too.
This to me feels like the ECB is the UN of central banks. And basically, they're trying to cobble together all of these different representatives from different nations.
No one's happy.
No one's happy. Everyone feels like they're being misunderstood, misheard, underrepresented. They feel left out. There's this feeling of just sort of basic resentment that there isn't some sort of recognition of their economic trajectory. In the U.S., it's a little different. I don't think that, Atlanta is battling with Philadelphia to the same degree, although we might get there. But it seems like there is a little bit more of at least a one-nation approach to it, which sort of leaves it with a different flavor.
And Lagarde's been very successful over the last few years about building consensuses and not having this kind of pushback, but you can start to see it building just a little bit more, relatively speaking, of course, over in Europe. Under surveillance this morning, US payrolls due at 8:30 Eastern Time. The median estimate in our survey expecting 180,000 added for the month of May. The number coming after a busy week of data, including surprises to JOLTS, job openings, and jobless claims too. 180 is the estimate for payrolls. For unemployment, 3.9%. And Lisa, as you know, that would be quite a run of sub 4% unemployment reads.
If that does end up being another month of 3.9%, it'll be the longest streak of monthly reads at 28 months below 4% going back to the 1950s. This is from Deutsche Bank's Jim Reed. It raises this question, are we more in a 1950s type of scenario, especially given we're not coming out of a war, but at the same time, the amount of stimulus was sort of reminiscent of wartime post-war recovery. So it raises this question, is that the paradigm rather than the 70s, rather than the mid-90s, rather than the late 90s?
Yeah.
How far do you have to go?
We'll talk about the economics, we'll talk about the markets. I think we've got to sit on the politics for a moment as well. The fact that you're going to have potentially 28 consecutive months of unemployment south of 4% and a president getting terrible reviews in the polls about his handling of the US economy is quite something. We talked about that poll from The Guardian a week or so ago. When you ask Americans right now where unemployment is, there is a decent segment of society who believe that unemployment is near 50-year highs. Near 50-year highs, even though the equity market's near all-time highs coming into this print, and unemployment's looking at a streak that you've just mentioned going back to the 1950s.
So a couple months ago, I read a report about sentiment around inflation, and I'll post it out there because I think it's actually really interesting. And it shows that in periods of inflation, even when the economy is doing well, people feel more just how much their overall costs are going up. Even if their overall paychecks are going up more, they feel bad because they know how much what they pay for should be or has been and what it is now. So there is a real psychological dampening effect of just how much prices have risen over the past 3 years. And there's not a lot he can do about that. I mean, a lot of people say that is just time because you're not going to basically say you should feel better. That is not what anyone wants to hear.
The price of NVIDIA does not take the temperature of how society feels about the US economy.
Well, and I would argue in some ways it just widens the division between the people who are able to invest in NVIDIA and those who aren't. And that's actually also what you're seeing, which is also showing a lot of dissatisfaction.
The president abroad today, of course. Today, the president, Joe Biden, meeting with Ukraine's President Zelensky to discuss the country's war effort against Russia. Then the president will deliver another address in Normandy ahead of the state dinner with France's Emmanuel Macron this weekend. And this goes back to a conversation we've had repeatedly. If you go to the polls consistently, for whatever the polls are worth, the top two issues for a lot of people, immigration is one, southern border, and number two, or number one, it's got to be the US economy. It's not foreign policy right now. It just does not rank that highly.
Which is the reason why the headlines coming from this speech and this event, yes, they're going to be the sort of necessary reminiscence of Reagan and all of that, but it's really going to be what happens with Russian assets in order to fund Ukraine. And the reason why that's going to be the focus of whether there can be some sort of agreement on how to unlock this money is because Biden cannot get the support domestically to provide those funds. There is not the willingness to finance some of these international conflicts. So actually, it's more interesting to see what they can do with some of the other countries rather than the messaging back home.
Going into the G7 leaders meeting in Italy next week, and you know who got the short straw. Because AMH is sort of like settled in Italy, getting acclimatized to the time difference.
Oh, yeah. It
Good
took
for
a week.
Anne-Marie. Yeah, just taking a week just to get used to it. You'll hear more from AMH at that Leaders Summit next week. Let's turn to GameStop, reporting 1Q earnings that missed estimates. The company taking investors by surprise. It was not expected to report its quarterly results until Tuesday. GameStop will not hold a news conference today, but someone else will. Keith Gill, known online as Roaring Kitty, will return to YouTube this afternoon with a live stream, his first in 3 years. Bloomberg's Tom McKenzie joins us now for more. Hey, Tom, what can we expect a little bit later this afternoon?
Isn't the timing fascinating? The earnings come out, it's a miss in terms of the share equivalent, at least in terms of the loss coming through, a loss of about 30% for the first quarter. In terms of the sales drop of 30%, I should say, for the first quarter. Look, there are only two estimates on this stock. So the details coming through, they got cash equivalents of about $1 billion US. Does any of that matter when you've got Roaring Kitty, as you say, doing the first live stream in 3 years on YouTube later today?
Lost.
Probably not. It's worth noting that he's got this, at least according to the screen grab, we haven't verified this, the options that he's got holding there in terms of the calls at around $20. He's sitting pretty as things stand on that front. So we'll see how it all plays out. But clearly, look, there's going to be a lot of volatility, you would have thought, around this stock on the back of the first live stream in 3 years. The stock is up about 190% just in the last month. Still down 50% from those 2021 highs, though, on GameStop.
Yeah, Tom, just to put some numbers on Sitting Pretty, his stake of 120,000 calls at $20 that expire on June 21st, now worth about $325 million. That would give him an unrealized profit of about $260 million. This isn't just small money for Keith Gill. It raises a question. What did you make of that new disclaimer on the website, on the YouTube screen grab, talking about this potential conference, basically saying, you know, we're not under any obligation to update or change. This isn't necessarily a recommendation to buy or sell. Things may not have. It's basically the classic legalese. This is the first time we've ever seen anything like that. How significant is that to you?
Yeah, maybe flashbacks to his time when he was grilled before Congress. Of course, does it really shelter him? Does it really put a safety net under all of this for him, protect him from that regulatory scrutiny? Look, we know, you know, hedge fund guys and girls come on, they talk their book, fund managers or at least owners of shares, they talk their book. Is there a risk here that he's going to face that scrutiny? Is that template going to do enough to isolate and insulate him from that? Look, and I wonder whether or not he's more cautious in terms of the content that he puts out on these live streams, given what he's gone through over the last few years, and the fact that so many eyes are going to be on this live stream when he takes to the airways, Roaring Kitty. It's intriguing that he's put it there, and maybe you get a more cautious live stream when Roaring Kitty takes the airwaves again.
Right now, a lot of people are expecting anything but. We're looking right now at GameStop shares that are up some 17%. I mean, they're moving around quite a bit in pre-market trading as people sort of game out what he might say. It just raises this question. I mean, how much is this a GameStop story of fundamentals not mattering? They just put out earnings that were hugely disappointing versus something that's broader, that speaks to some of the lack of logic and some of the moves that we've seen on the peripheries.
Well, how much does it tie back to the conversation that you and John were having a couple of minutes ago about central banks, the reaction function there, the liquidity still in the system, the argument from some that conditions remain relatively loose? If there is all that money that can be put to play in these meme stocks, you're absolutely clearly it's not about the fundamentals, is it? When you have the bigger loss per share than estimates and that drop in sales of around 30%, bringing in sales of about 888 million or so in the first quarter. This is a play. There's a speculative play. Would be the argument. Of course, there's a big short position as well, still in GameStop. So the shorts are feeling the squeeze. I think there's about a 20% stake in terms of the short position is about 20%. So that's potentially a ramification as well in the next few days. So we'll look at those short positions, I think.
Hey, Tom, great work. Tom McKenzie out of London. I think Tom absolutely nailed it. I'll tell you why. You've watched the movie, I Have Too, Dumb Money, which is a great title because typically it's the institutional money looking down on retail money as dumb money, but the dumb money this time was the institutional money. You remember the testimony and the way it was sort of conveyed through that movie, right? And you remember Keith Gill sitting there, there's no one else behind the camera, he's alone, he's on his own. Then everyone else from institutional Wall Street just has a row of lawyers in front of them, telling them what to do, sort of prepping them and getting them ready. I wonder this time around, given the resources that Keith Gill has, how much legal advice he has taken going into this stream. I think Tom is absolutely right. That would be the number one question I have. How much legal advice has he taken going into this one?
Which is the reason why I thought that disclaimer was fascinating. The first time we've seen that at a time where this is somebody who is, you know, video casting from his basement wearing often a red bandana. So it raises this question of, has his investment policies changed just slightly based on maybe his eyes being opened a little bit more?
Or becoming more refined. Their stock is up in the pre-market by a little more than 20%.
Refined?
Yeah. You know,
about
sort
his
of
process?
taking advice
Yeah.
about what you can and can't say.
Yeah.
Absolutely.
I think that he'd lose support, though, if he did that. If he came out and he's like, I'm not really sure, you may or may not believe what I'm about to say, I think it would sort of diminish some of his appeal.
We'll see what we get a little bit later. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Mexico's peso sank after a leader in the ruling party said lawmakers would seek to pass reforms that could remove checks on government power. That set of reforms were proposed by outgoing President Andrés Manuel López Obrador will be discussed when a new Congress is seated in September. The prospect of a policy overhaul before President-elect Claudia Sheinbaum takes office in the fall, sending the peso tumbling near 3%, on track to close at its weakest since October. Hertz is considering a sale of at least $700 million in secured debt, as well as a convertible notes offer. The company's advisors have begun contacting potential investors regarding the secured debt issue, according to people familiar with the matter. No final decisions have been made. And the U.S. team has pulled off one of the biggest upsets in Cricket World Cup history with a shock win over Pakistan. The super over victory, which is cricket's equivalent of extra time, puts the U.S. in a strong position in their group after their earlier win over Canada. The U.S., which features players that have taken time off from their full-time jobs for the tournament, will face another heavyweight on the sport on Wednesday when they meet India in New York. That's your Bloomberg Brief. John?
Yahara, thank you. Pause. That is like Pakistan beating America at basketball.
Oh,
that's
yeah.
how ridiculous the outcome of that is.
No, that's insane. Even I know that's insane. And as much as I follow cricket, the fact that even I know tells you something.
Absolutely nuts. Up next on the program, jobs data on deck.
I think the bar for bad labor market data for the Fed to be cutting sooner than the market is pricing is pretty low. I think we're going to see 140,000 payrolls, which is a further slowing, obviously, from the slowing we had in April.
That conversation just around a corner. Equity futures on the S&P treading water going into this one and very close to all-time highs. The estimate in our survey, 180K. The payrolls report, 8:30 Eastern Time from New York. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Who said fundamentals don't matter? Check out GameStop. Was higher by 20%, now lower by about 8%. Fundamentals, here we go. Well, GameStop may sell up to 75 million shares of Class A stock. That headline dropping just moments ago.
Yeah, well, if you keep talking, maybe it'll revert back to up 20%, because it seems to be whipping around pretty quick at this point, given the battle that's going on between basically the memers and the shorts.
And let's just say that dip is getting bought. Their stock is now negative by about 4%. in the pre-market. More on that a little bit later. And the surveillance this morning, jobs data on deck.
I think the bar for bad labor market data for the Fed to be cutting sooner than the market is pricing is pretty low. I think we're going to see 140,000 payrolls, which is a further slowing, obviously, from the slowing we had in April. The level of job growth, that's still a pretty healthy level, but it's the trend that's concerning.
It's the latest May jobs data due out in less than 2 hours' time. The median estimate in Bloomberg's survey calling for payrolls to rise by 180,000. Michael Pugliese and the team at Wells Fargo expecting a print of 195K. We think the pace of jobs growth over the next few months will look more like the April pace. April demand should still keep employment growth below the robust pace registered in the first quarter. Michael, I'm pleased to say, joins us now for more. Michael, great to catch up with you, sir. Talk to me about these expectations, not just on headline payrolls, but also on unemployment too, and wages as well. What are you and the team looking for?
Yeah, thanks, John. What I would say is I think we can get a little bit of a bounce back here in April, just given that payroll growth was pretty weak in a couple categories in April that had been so slow in things like government and leisure and hospitality that were slow in the month, but were very strong over the course of the first quarter and the couple quarters before that. So I think in some of those categories we can get a bounce back in May and get to that 195,000 number we're forecasting. But on trend, it does still look like things are slowing down some, whether it's the unemployment rate that's ticked higher or the U6 underemployment rate that's creeped up about a percentage point over the past year and a half. Obviously, you saw it in job openings and other data this week. So I think that even if we get a little bit of a bounce back today, you're still seeing a labor market that's coming into better balance and cooling on trend.
I have to say, Michael, Stuart Kaiser really set the tone when he said, if it's 150 or below, terrible news. If it's 175 or above, I'm a full bull. I mean, how narrow is the gap between what we could get that could really shift the needle in sentiment to either this is an economy that's really on a downward track, or actually this is really stable and we're doing great?
Yeah, I don't think it's that narrow. I think with the economic data like this on a monthly basis that's revised and up and down, I don't view it as, take this one print and be super bullish or bearish. You take a 3-month moving average and through April, even with that slowdown, you're still at 242,000. So even if that downshifts to something like 200K, 175K, that's still a pretty healthy set for job growth. And you look across other economic data, yes, we've downshifted, but I think some of that was to be expected over the course of this year. So even if it's 140,000 today, I'm not going to be too worried and be looking for other signs beyond that. I think it would take for me to have some evidence that I'm concerned.
When you dig into the internals, I'm curious how important it is to see where the job growth comes from. Say, if it's government jobs, well, that's probably going to be a little bit bearish for some people just because that can't continue forever. It's not like the private sector is really going gangbusters. If you see a revival in leisure and hospitality, because we've seen a real slowdown there, can you give us a sense of which sectors will be responsible for the bulk of the hiring and why that's important?
Yeah, it's a great question because this is something I get asked a lot. Why hasn't the labor market slowed down? Why haven't we seen more signs of it? And I think we have. And that's a good example where you've seen job growth that's narrowed up. The breadth across industries is just not as strong as it was. And what you've seen is job growth that's been led by sectors that are less cyclically sensitive, things like government and healthcare. And so that's, I think, another area that I'm looking to see, okay, even if we get an upside beat, is it concentrated in those industries like government, healthcare, leisure and hospitality that have just been strong a little more structurally than cyclically? If so, I think that's still evidence that the labor market is coming back into better balance, and it's not nearly as tight as it was 12 or 24 months ago.
So how relevant right now is average hourly earnings? Because a lot of people used to emphasize this as the most important part of the report. This time around, it's really de-emphasized. Why?
It's because it's been so noisy. So average hourly earnings is a little bit more of a crude metric for wage growth. And you saw it spike dramatically in April and May 2020. That was really just sort of a function of how it's calculated. Then you saw this big drop in 2021, and there was noise. And I think that's why the Fed and others have put more emphasis on other measures of labor cost growth like the employment cost index. Now, I think as we get further and further from the pandemic, it goes back to being as relevant as it was maybe in 2019. I don't think we're quite there yet, but we're getting closer. And in fact, you've seen slowing there too. So average hourly earnings was below 4% on a year-over-year basis last month for the first time in about 3 years. And so even there, again, that data has been more noisy than it has been historically. But even there, I think you've seen some signs of labor market cooling in recent months.
And Michael, if we come down to 150, 160, what is the strongest argument that this is just rebalancing and not something worse?
Yeah, I mean, I think the strongest argument is that you have to get back to steady state eventually, right? All roads lead to a slowing down here to something like 150, I think 125,000, something closer to steady state employment growth. What's hard for the Fed is, sticking that landing, right? You want the economy to slow down from the 600,000 plus jobs we were adding a couple of years ago, and that's what we've seen. It's gone from 500,000 a month, 400, 300, closer to 200 now. And I think the hard part is sticking that landing at around 150,000, give or take a little, and not having the inertia carry you even further lower. And that's why I think the risks on monetary policy have gotten two-sided. And yes, inflation's still above target. Yes, the Fed has to be kind of cognizant of that, but it doesn't want to see employment growth that slows from 150 to 100 to negative and then find itself in a recession, later this year in 2025.
So do you think this Federal Reserve is just as sensitive to the data we get this morning as they will be to the data that we get on Wednesday morning?
I do. I mean, I still think CPI reigns supreme here in terms of the inflation data, but no, I think the employment data is absolutely something people are keeping an eye on, particularly the doves, and particularly in light of some of the more recent data we've gotten, whether it be the somewhat softer number in April on NFP, the creep higher in the U3 and the U6 unemployment rates, the job openings numbers, which we just talked about, that are down a third. So I think that CPI is probably still going to have the bigger weight for markets and for the Fed, but NFP is always going to matter, particularly as you start to see some slowdowns below that 200K mark.
It seems like soft landing is still consensus right now, pretty much across the street. I'm just wondering if it's gotten a little less confident over the past couple of weeks, whether you've seen and heard and whether you yourself kind of believe that a chance of a harder landing is looking more likely than it did, say, a month ago.
Yeah, I mean, I think the probabilities maybe gone up a little bit, but it's more directional than it is a big magnitude. I mean, ultimately, one, it's only been a few weeks of softer data. And two, the data haven't been that soft, right? It's just been softer relative to a Q1 where we were booming. And you had job growth that was very strong, inflation numbers that were very high. And so it was kind of always our expectation that as the year progressed, we would move slower in activity and hiring and inflation relative to what we had in Q1. So, maybe on the margin, that probability has gone up a little bit, but it hasn't certainly gone up for us. It's nowhere near a base case. And I think what's encouraging is that you do have a Fed that's cognizant of these two risks. I think it's pretty easy to envision a different Federal Reserve, that looks at inflation that's been above target for 3 years and says, we're not going to really consider the employment side at all here, just full steam ahead on slowing down the inflation side. And I don't think we're seeing that right now.
Appreciate your time, Michael. Thank you. Michael Pugliese there of Wells Fargo, looking for 195. The estimate in our survey, 180. It doesn't matter what this number is at 8:30. That debate's still going to be wide open. Is this rebalancing, or are we going somewhere worse? And why would we stabilize at this sort of like perfect 165, 170, 175?
Because why not? I mean, why not feel good? Things are fine. And so that's basically what everyone's kind of sensing. I mean, there aren't the signs of weakness. You could make an argument that you've never seen this kind of perfection that lasts for a longer period of time. You could also make an argument that in the K-shaped recovery, there just are two different economies that are battling each other out, and one has a sort of sledgehammer, and one has a toothpick in terms of spending power, and those are sort of the things that are really battling with each other.
I think whatever happens at 8:31, we'll still be vulnerable to whatever happens at 8:30 on Wednesday morning.
Oh, of course. 100%.
CPI is going to be back into play, and you can see how sensitive we've been to the economic data every single morning so far this week.
It's frustrating. Honestly, it is frustrating because there isn't a cohesive narrative coming out. It is clear slowing, but not necessarily slow. That doesn't mean anything to people who are looking for a trend. I mean, that's typically what Wall Street looks for, is the trend line.
The conversation continues. Coming up next, in the second hour of Bloomberg Surveillance, Priya Misra of JP Morgan, Bloomberg's Michael Shepard, Becky Frankiewicz of Manpower Group, Alan Zettner of Morgan Stanley joining us as well. Looking ahead to the payrolls report, just about 94 minutes away.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We're
operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power.
This is Bloomberg.
Suppose the unemployment rate goes up, but job growth stays strong. That's sort of a perfect scenario.
I think we are going to a more normal, gradual pace of job creation.
We should be talking about the other risk. Employment could really weaken.
I don't think 150 would be such a bad number.
The soft data has been telling us that the economy stinks. It's the hard data that is actually going to move the needle.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. Let's get straight to the numbers and straight to the big estimate. Our survey says 180. That's the median estimate in our survey. The previous read, the last month, 175. The unemployment rate, looking for that to stick at 3.9%. It's a two-part story going into the Federal Reserve next Wednesday. Payrolls this morning, then on to CPI next week.
In terms of payrolls, we're sort of to set this up, we saw last month the weakest pace of job creation in 6 months, albeit coming off a pretty high level. Raises this question, can we start to see some sort of trend, which is the reason why so many people are saying this is a pivot point. Andrew Hollenhorst in particular. Take away what exactly their call is, bullish or bearish. It does seem like we are reaching an inflection point to really understand whether the weakening has become a trend, and then we can debate what the trajectory of that is.
Is it rebalancing or something worse? Chairman Powell's got a big job in the news conference to do. Just to go through some of the research on the South Side, Alan Zenner of Morgan Stanley is going to be joining us later. Thinks that Chairman Powell will emphasize patience in this news conference. Peter Cheer, completely different view over at Academy. looking for Powell to put July firmly on the table in the news conference next week. That is two very, very different views of the same chairman.
And it really comes down to cynicism, frankly. And I don't mean this in a negative way. I mean this actually just completely in the sense that Ellen Zentner, we've talked to this about her. She basically has said, you know, she doesn't believe in political interference or this idea that the politics will hang over the Fed's decision. And Peter Scheer says, actually, that's not the case, and that he sees a July rate cut because any sooner to the election, closer to the election, they'll open themselves up to that kind of political accusations that they'd like to avoid.
Would you like to see some volatility? We can do that. GameStop in a pre-market. That stock was up by more than 20%, and then it was down by about 10%, and now it's positive again. It was down off the back of this headline that dropped just 15, 20 minutes ago, that the company may sell up to 75 million shares of Class A stock and intend to use the proceeds for general corporate purposes. We dropped, and that very quickly got bought.
So this is a battle between the people who follow Keith Gill, or Roaring Kitty, and basically the hedge funds and others who are short sellers who have a huge short position still on GameStop. And it raises this question, and Julian Emanuel portrayed this really well, which is essentially, is this just an idiosyncratic sort of issue with this one name, or is this a broader kind of signal to the markets about what kind of froth there is currently in the markets? I'm not going to get into that debate, but you could make the argument that if people have money to be playing around in stocks and to be throwing away in that, you know, it raises this question around the margins. I don't know if it's frothiness or just sort of a desperation to get into the casino.
I'm happy to get into that debate and pick up on that word casino. Just because you found a casino does not mean the whole place is Las Vegas. That's what I've always said about this particular issue. It doesn't mean that everything else is absolutely nuts. This has been going on for years now. And ultimately, what's the equity market done? Up and to the right.
Well, and I could take that a step further, and I think you're correct, which is this in some cases like a lottery ticket. For a lot of people who are looking at a lot of people getting rich off the market and putting their money in the market and saying, okay, we can do this, this, and this, and all these nuances and make a lot of money. We want in on that too. If this guy can get us there, we'll go there. And so it raises this question too of people who are not able to access a market that has really bolstered a lot of household income sheets.
Yeah, well said. There are a lot of dimensions to this story. I can offer you the numbers right now. First quarter net loss for the company, $32.3 million. There will not be a conference call a little bit later, although there kind of will be with Keith Gill himself. There's going to be a live stream a little bit later on YouTube.
Yeah, with a complete legal disclosure that is new about what not to follow, and that this is, you know, not necessarily a recommendation.
I'm with you. It's notable. It's notable. Let's get to the scores. On equities right now, on the S&P 500, we come into Friday really, really close to all-time highs. We just pulled back a little bit. We're down by not even 1/10%. We go into payrolls with quite a rally on the bond market. This time last week, we're in the 450s. We're back down to the 420s on a 10-year.
Which is a reason why a lot of people are arguing, including Veronica Clark over at Citigroup, that the market's kind of readjusted, and any kind of downside surprise might have a more limited effect on any kind of treasury rally that we get. We shall see, because it depends on whether people talk about an adjustment, to your words, or some sort of, you know, recalibration, or whether this is going to end up being the beginning of something that people sniff out has some sort of deeper legs.
You know where the bias is right now, consensus, right? We just keep hearing the same word, rebalance, normalize, adjustment. Then we stabilize, right? Everything's going to be okay.
You know, this is the tricky thing about this data and why it's been frustrating, because there are a lot of reasons to believe that, but you can also make a really good argument on the other side. So pick your poison, you know, basically.
Pick your journey, pick your poison. Here's the lineup this out. JP Morgan's Priya Misra on why markets are focused on growth over inflation. Bloomberg's Mike Shepard with NVIDIA and Microsoft facing antitrust probes. And Morgan Stanley's Ellen Zentner looking for a payrolls print of 220K. We begin with our top story. The jobs report about 90 minutes away. The median estimate in our survey looking for 180K. JP Morgan's Priya Misra writing this. The market is more focused on growth than inflation. Rates and risk assets have reacted more to downside surprises this week. Maybe the Fed can cut, but the lags work both ways. So a slowdown in growth would be problematic. Priya's with us around the table. Priya, good morning.
Morning. Thanks
for the market, are we saying that payrolls this morning is more important than CPI next week?
I think so. I mean, the Fed has a dual mandate, so both are important. But look at what's happened with inflation. You know, this re-acceleration risk, that sort of went away with April. Now, the Fed has to be a little careful, so I don't think they're going to signal rate cuts. But look at what's happening on the growth front. Things are slowing. There's no question the economy is slowing. Are we slowing to a normal, slightly below trend, or are we continuing to slow? Recessions are typically non-linear. So when the unemployment rate starts to go up, it goes up really fast. I think the market's getting a little focused on that. And look at market pricing. We're priced for a soft landing. So what's the risk to that? A recession, I would argue, or a bigger slowdown. Slowdown below trend closer to zero, I think that is the risk that the market's starting to sort of zero in.
Priya, what are you saying here? That you don't buy the rebalancing story, or you just don't think the opposite is well priced in the bond market?
I would say the latter right now. The market's pricing in the soft landing, that we stay in this perfect nirvana mode where the Fed cuts just enough to keep everything going. Well, what if the Fed is not able to cut up until the end of the year? What if inflation remains sticky? They get nervous, they don't want to sound political, so they cut a little late, then they cut really cautiously. And meanwhile, the economy is slowing down. Those lags that we've been talking about now for 2 years, those lags do work both ways. So the Fed can cut, but if they cut what's priced in, what essentially the market's calling for, you're not going to get any further easing in financial conditions. So I think Fed cuts, preemptive cuts, are essential for the soft landing to continue. If inflation doesn't let them do that, I think then we're looking at a bigger slowdown.
Can we jump to the conclusion? What do you buy right now?
It's hard. You know, if you were to give up on risk assets, it's expensive. So I think you're supposed to own high-quality spread product. I think fixed income makes a lot of sense. For the first time in years, you're getting income, you're getting real income. But I think you're supposed to hedge that downside risk. And these correlations that have been extremely unstable, I think if you look at the risks right now, the Fed is telling us they're going to respond aggressively if the economy slows down. Buy duration, buy 10-year notes. Now, we've moved a lot this week, so I would be a little careful going into this number very long. But I think at 4.30 on the 10-year, you know, what's the market pricing in? 2 cuts this year, 3 cuts next year. The end point at 3.5. I mean, I think the neutral rate is probably above 2.6 that the Fed calls for. It's probably not 3.5. And where's the recession risk priced? Nowhere. So I think you own risk assets carefully. You have to know what you own. You have to understand the balance sheet, what are companies doing with the debt, and then own some duration for that downside risk if things slow down faster.
This is fascinating. You seem to agree with Neil Dutta, actually, over at Renaissance Macro. He basically said he thinks that the Fed is about to make a mistake if they don't cut soon, because they will then avoid achieving that soft landing, which seems to be what you're saying. These sort of preemptive cuts are essential for getting that soft landing. Is that correct?
So, I struggle with whether they're making a mistake. I give the Fed a lot of credit. They pivoted. Now, the market does this. We overdid it. But the Fed pivoted in time. Financial conditions were tightening in the fourth quarter, and the Fed said, not so fast. We're done with hiking effectively, as much as they could say that. They said it again. It's a bumpy inflation road. So I think the Fed is trying to create room. I'm watching that dot plot next week. If they still talk about 2 cuts as their baseline median, they're giving you that optionality that, hey, they can cut in September. I think they're going to cut in September. They're going to cut in December. The market's going to then run with it and price in more cuts. So I don't think they're at the policy mistake point. Does inflation allow them? Do wages continue to decelerate? Inflation is notoriously hard to forecast. That Wednesday number is important, John. But if you get a 0.2, 0.3, I think it gives them policy room to cut. So I don't think the mistake is here. If you don't get that inflation number and they're unable to cut, I think that's where that policy mistake is in front of us.
We were talking about how this is frustrating. And I'll tell you why, because I've heard people who I really have incredible respect for make arguments on all sides. And actually, I buy every argument that they make, and they're making exact opposite arguments. There were people a week ago saying that there's a serious risk of a re-acceleration in inflation early next year, that there would be potentially a rate hike next year. It made logical sense about why, from a policy perspective, from the year-over-year comps, from some of this inflation data, from some of the resilience in the labor market. How do you have confidence? Where can you get confidence that that's not one of the scenarios baked in here at all?
I think you look under the hood. So I hear you. I mean, it's a K-shaped recovery. Monetary policy is extremely restrictive, and cost of capital is so high for a certain part of the business sector, for a certain part of the household sector. It is not restrictive for another part. And which one wins out? And we're in this tricky time, and it could take much longer than the market wants to figure out who's winning out. So I would look at underlying trends, job openings. That's slowing down. Once that rate gets below 5%, I get nervous. Governor Waller said 4.5. I don't know, somewhere in that range. The unemployment rate starts to rise. Let's look at the number today. I think 150 is priced in. You start to get below 150. Remember, we've all for years thought 100 was the level. Anything below 100 is a problem. Given labor supply, what if that number is 200? So we'll be debating, even if the number is at 150, are we slowing too much? I think that's going to be the debate. So you look at everything, the totality of the data, as the Fed puts it, and keeps us all in business, where we're looking at company fundamentals, macro data, the distribution of outcomes. I think it's really important to look at that distribution because it's a very bifurcated economy.
Can we do a little bit of scenario analysis? I think the most difficult call for a bond manager to make right now. What would happen if we had payrolls disappoint today, but then CPI came in at a punchy, like 0.4? What would you do with bonds? What does that mean for fixed income?
I think you buy.
Where do you buy?
Given the levels, I would say you buy 5s.
Okay.
Because if inflation is a little sticky, it's going to be hard for the Fed to communicate cuts that day because we have the meeting right after. So I think you buy a little further out because I actually think if the inflation number is high and the Fed doesn't cut, the risk of a hard landing is much higher down the road. So then you want to own a little further out because the Fed's going to keep that front end anchored. And then by the time the economy slows down, the Fed responds, it's going to be too late for the economy or too late for the soft landing. So I think you buy 5s. If payrolls is weak and inflation is stable, I don't think you need real weak inflation. 0.2, 0.3 a month over month is enough. Then you start to buy 2s, front end, the curve is going to steepen significantly then.
To sort of put a bow on that point, there's a real question, and I see this in a lot of the research, about whether at this point unemployment has become more important right now than CPI prints, just simply because this dual mandate is sort of taking on a different meaning. Would you say that's the case?
Yes, absolutely. I think the market's paying more attention to it. The Fed kind of told us they're paying more attention to it because inflation, a year ago, PCE was 4.3. It's now 2.7. We're getting close to that 2.5. I think we're in that range. The Fed's telling us, well, the unemployment side is what they'll respond more to. So I think the market, the Fed, we all need to be looking at the growth side, which we haven't. For the last few years, we've taken growth for granted and we've been focused on inflation. I think we're in that shifting inflection point right here.
The nightmare is if the dual mandate goes into conflict. I mean, that's like the ultimate nightmare for any policy official. Priya, this was wonderful. It's always good to see you on payrolls. Thank you. Priya Misra there of JP Morgan. Equities right now on the S&P 500, just a little bit softer here. We're down about 0.1% as we count you down to that payrolls report. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Shares of GameStop whipsawing in the pre-market. The company announcing it may sell up to 75 million Class A shares and plans to use the proceeds for what it says are general corporate purposes. The news coming alongside disappointing first quarter results and ahead of a YouTube live stream by Keith Gill, known online as Roaring Kitty, whose social media posts have sent the stock soaring over the past week. Hong Kong will no longer close its stock market during typhoons and heavy rainstorms starting as soon as September. According to sources, Hong Kong Exchanges and Clearing is expected to announce the plan in the next few weeks. Hong Kong has been an outlier among major financial hubs in having rules to close its $5.2 trillion market amid inclement weather. And the official start of summer here in the U.S. may still be 2 weeks away, but the Southwest is already experiencing its first heat wave of the year. Temperatures soared past 110 degrees Fahrenheit from Southern California to Arizona. The National Weather Service extending its excessive heat alert until Friday night in most of the region and through Saturday in Las Vegas. At a Trump campaign rally in Phoenix, 11 people suffered from heat exhaustion and were taken to the hospital. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, AI under the microscope.
I worry that the concentration of AI models with access to huge amounts of consumer data in the hands of very few companies could pose enormous risk.
We talked about this earlier this week. What if NVIDIA wanted to buy something? And we talked about ability. Got the ability, willingness, possibly. What about the approval? Would Washington approve? And you were like, don't think so.
Well, pretty much on cue. There they go. Well, we're very concerned.
The latest from D.C. is coming up next from the nation's capital. Looking ahead to payrolls, 8:30 Eastern, we're looking for 180K. Equity futures lower by 0.1%. From New York this morning, good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Here's the stock market for you. Equity futures just a little bit softer here. No drama, though. We're down by about 0.1% on the S&P 500. Just to wrap up the conversations we've had so far this morning, Stuart Kaiser of Citi has said it repeatedly, firmly in the camp that bad news is bad news and good news is good news, and the difference between the two is 175 and 150, apparently. And what we just heard from Priya Misra of JP Morgan, that ultimately for the market, this job sprint this morning, in her view, her opinion, is more important than CPI on Wednesday morning.
And just to frame this, the Citigroup and July and the JP Morgan base cases, actually, both of them are now calling for a July rate cut. So they're sort of coming from the same place. They're sort of singing from the same hymnal, which is this is an economy that's weakening, and the question now is just how much.
Mike Feroli, Andrew Hollenhorst, both Team July. We'll see. That's very dependent on the economic data we get between now and then, particularly the next CPI print. Under surveillance this morning, AI under the microscope.
I worry that the concentration of AI models with access to huge amounts of consumer data in the hands of very few companies could pose enormous risk, including around consequential economic decisions and access to opportunity, information, and privacy. It is emphatically our responsibility and obligation to support open and fair markets and prevent monopolies in their incipiency.
Here's the latest. US regulators opening antitrust investigations into Microsoft and NVIDIA over the rapidly emerging field of artificial intelligence. The probe's focusing on Microsoft's ties with OpenAI and NVIDIA's dominance in AI chips. Bloomberg's Mike Shepard joins us from the nation's capital for more. Mike, give us a bit more detail. What are they focused on? What are they disappointed by? What are they worried about?
Well, you know, the inquiries are very early at this stage. We just learned about them earlier this week. But what we're seeing already is a focus on two things. For Microsoft, it is this question of the relationships it's forging with companies, namely OpenAI, but there are others as well. And rather than buy these businesses outright, Microsoft is making investments in them and swapping employees and having this kind of exchange of information, but all of it taking place away from the radar screens of antitrust enforcers. If it were an outright acquisition of OpenAI, naturally they would have to go to the feds for some sort of blessing. But these kinds of investments have so far evaded scrutiny, but it's a lot of money at stake and it's a lot of technology and people at stake too. Likewise, with NVIDIA, what they're looking at is how this company has been allocating chips in the marketplace. At practice, it has acknowledged getting semiconductors that it makes for AI use to companies that are most likely to use them most quickly. And this is in part because there is a natural scarcity of these kinds of chips out there. It's just something characteristic to the industry, but it is something that raises questions about the company's dominance.
We had this conversation, Mike, yesterday with Mandeep Singh in terms of what acquisitions would be sort of in the crosshairs of some of this regulatory scrutiny. And it sounded pretty specific for NVIDIA. It had to be away from chips, et cetera. But I wonder, based on the wording of the federal statement, whether this goes beyond that, whether this goes to data acquisition, whether this goes to just in terms of a dominant position overwhelmingly in a marketplace that can be sort of more ambiguous at a time where everything, every input could be added to the advantage that some sort of machine computing technology can offer.
Yeah, I'm glad you asked that, Lisa, because this is going beyond just the simple question of acquisitions. It's really in the relationships that are being forged. It's in the investments that are being made. It's in the technology that could be exchanged or discussed between different companies. And really, every move will be under scrutiny now. And one area that is a part of the agency's focus are the interlocking directorates that you see between some of the bigger companies and then some of the startups too. If you see a little bit too much overlap, that is a cause for concern among antitrust enforcers.
And Mike, what can they actually do? Because ultimately a company like Microsoft doesn't have to buy the company, they can just hire the talent and offer them a lot of money to bring them over. This is kind of what Lisa's alluding to. What can they do about that?
Well, they can go pretty far, and this will be interesting to see what they exactly have in mind as remedies. And the catch is this for them. AI is such a rapidly emerging and nascent field that, the industry, of course, is saying that, look, if you keep cracking down on us at this stage of the game, you're going to stifle innovation. And yet, at the same time, you heard the Federal Trade Commission official today saying that they are concerned that if the government doesn't act, it will set the stage for market dominance for decades to come. So what we would look at is what sorts of handcuffs would they put or restrictions would they put on, for example, the types of investment, the types of relationships and exchanges of employees, what they have to report to the government, and then how much they have to ensure that the playing field is open for other competitors as well.
Mike, let's build on the politics of the moment. You have sort of the question of how do you regulate this and sort of the actual procedural aspect. But then you have this idea that Governor Gavin Newsom, to your point, came out and warned against overregulation, saying we need this innovation. He was speaking at an AI event in San Francisco, so it seems like a pretty logical place to talk like this. Is this sort of an argument that's breaking down along sort of partisan lines? Is there some sort of clear-cut division in Congress as for who wants to regulate more and who wants to regulate less?
Well, traditionally, you've seen Democrats favor more government intervention in markets, especially in areas of competition. And we've seen Republicans, urge a more hands-off approach so that industry doesn't feel like it's being stifled. And in fact, we heard our colleague Caroline Hyde interview Eric Schmidt just a few weeks ago, and he really railed against this whole idea of too much regulation too early against artificial intelligence technology and investment. He said it would be something that would hurt innovation, that would hurt growth, and he specifically cited efforts in the European Union as being premature and not very well thought out. And he urged U.S. regulators to take a more cautious and more thoughtful approach. Now, so far, when it comes to Congress, we've seen lawmakers actually from both sides of the aisle express concern about the risks posed by AI. It's not just so much on the competition front, it's on the larger question of data privacy and how is the technology being used. And we even see some within the industry warning about existential threats. So it is something new and even a little bit scary to people in a way that some lawmakers, even on both sides of the aisle, are not as afraid of talking about regulation in a very open way.
If I was a politician, I'd be very worried about the prospect of job disruption and societal upheaval. Something to think about. Mike, thank you, sir. Mike Shepard of Bloomberg. Almost sort of bizarre that we're talking about an industry in its infancy after we just talked about a market cap of NVIDIA of $3 trillion. Sort of a little bit late here, aren't we?
That's exactly where I was going to go. I'm so glad you said that. This sort of feels like someone regulating a kid on their iPhone who's already had it for 5 years and also has it attached to their MacBook and their other kinds of devices, and they have all other ways to access it. And someone's saying, well, on your iPhone, you're going to delete this app. And they're like, okay.
The horse is like 10 miles away.
So
and DC's like, quick, bolt the doors.
Yeah.
And come on. Coming up, Becky Frankowitz of Manpower Group on the quote, steady as she goes, job market. That's next from New York. This is Bloomberg.
your tongue. Britain's next.
It was going to keep reading World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Jobs report, 60 minutes away. Scores, equity futures negative by almost 0.1% on the S&P 500, totally unchanged on the Nasdaq 100, a little bit softer on the Russell. On the small caps, we're down 0.2. How many times have we seen this? 1 hour away from payroll, sort of treading water, going nowhere in the stock market.
Yeah, interesting to see whether the first reaction is going to be the right reaction for this one, because it seems like there's so many different sort of iterations of this jobs report, the headline, the revisions, whether we get our, et cetera. You could just imagine that it's going to be a whipside.
People are going to make up their own mind about what to focus on. It's like the ISM services. I thought headline mattered, firmer than expected, and then it was like, no, the employment component is the big piece of this particular data point. That's what you need to focus on.
It's frustrating. This is a frustrating kind of moment where everybody's just basically an incredible salesman to draw together the ideas that sort of represent their case, and they make a good case. I think you're a good salesman.
A strong case. We believe you. Both sides, apparently. You believe both sides.
Absolutely.
Of course, okay. Our jury says, sort of got no idea, all right? In the bond market, 2-year, 10-year, 30-year, looks like this. A 2-year yield a little bit higher by a single basis point. The 2-year at the moment about 4.74. Talked about where the 10-year was this time last week in the 4.50s. We're back down to the 4.20s after a pretty strong rally so far over the last handful of days. Think about the data we've had. ADP came in softer than expected. Job openings came in softer than expected. We talked about the employment component of the ISM, softer, the headline ISM manufacturing. You put it all together, Lisa. That inspired a bit of a bond market rally coming into this morning's number.
What you can see now is 2 full rate cuts being priced into the market by the end of the year, starting in September and then again in December. And this raises the question of just the readjustment that you're talking about, or whether this is the beginning of a trend. I will just say Torsten Slok, who has been talking about no rate cuts, continues to sound out missives this morning. Global economic outlook improving is the headline to his latest one, and he's talking about how it's actually a reacceleration. Again, you can make an argument on all sides and point to this and sort of explain why this is just sort of a downshift in something that could reaccelerate, or the other way around. It's confusing at this moment.
And not just at the Federal Reserve either. I think that's worth saying. Let's turn the page to the FX market. We can talk about the euro just briefly. We got through 109 yesterday. We're back down to about 108.90 something. For the ECB, we thought this was it, right? You start cutting in June, you'd go again maybe in July, perhaps again later on in the year in September, and think about doing the same thing again later this year. And then all of a sudden, we're talking about maybe one and then none. And that's a massive change. So you mentioned Torsten. Torsten, great call so far this year. It's working out. A lot of people in his camp thinking maybe this Fed doesn't cut for the rest of 24. What about the ECB? Does that call sound that crazy anymore to say the ECB won't cut interest rates for the rest of this year?
No. In fact, some people are coming around to maybe just one more rate cut this year rather than 3 or even 4. We talked earlier, you said, how big is that divergence really between the ECB and the Fed? What divergence? Because we're talking about a very similar kind of paradigm. So at this point, a lot of people are betting on a global rate cutting cycle. Can we say that it's actually going to be a rate cutting cycle, or just small tweaks on a really bumpy road that we really can't define yet?
The dot plot, one to watch on Wednesday as well. Does it show 2 cuts this year? Does it show 1? And then we can talk about how much daylight there actually is between what the Federal Reserve's sort of projecting and what we're hearing from the ECB. Under surveillance this morning, here's a story for you. Israeli Prime Minister Benjamin Netanyahu accepting an invitation to address the US House and Senate on July 24. According to Speaker Mike Johnson's office, some Democrats, including Bernie Sanders and Nancy Pelosi, saying they will boycott the address, which is kind of shocking given that Israel is a big ally of the United States.
This is going to be an interesting division between Republicans and Democrats, because Republicans plan to embrace wholeheartedly Benjamin Netanyahu. We heard Mike Johnson talking about how happy he was that he was coming, etc. And then you have the likes of Chuck Schumer saying, we support Israel regardless of who's the leader, but he thinks that this is somebody who should step down. So it really raises the question, how do you sort of, I don't know, thread the needle in expressing displeasure about what's going on while not backing away from an ally of the United States that's crucial for the regional security, at least according to some people. So you start putting these things together and you wonder at what point are people messaging for the election? At what point are people actually sending a geopolitical message? It gets pretty hairy.
Yes. All of the above. I think particularly the election.
Yeah.
It's just another date to circle on the calendar, the political calendar for the next couple of months. I want to turn to this story, a single name for you. GameStop shares whipsawing in the pre-market. I'm not even sure that whipsawing covers it. We were up by more than 20%. We were down by more than 10. We're now down by 9%. I think at one point we were climbing 37% at the height of the session. The company reporting disappointing first quarter earnings and saying it may sell 75 million shares. GameStop had been scheduled to release earnings on Tuesday. They come early and they come ahead of a planned YouTube live stream by Keith Gill, known as Roaring Kitty online, who has powered meme stock mania and driven GameStop shares higher over the past week with his social media posts.
Some people thinking about the irony that it would be for Keith Gill to become a billionaire, which is potentially going to happen if the shares get up to $65 today, after basically trying to excoriate the billionaires out there. It's sort of this incredible irony of the moment. Just to put this into perspective, GameStop shares at the peak of meme stock mania was almost $87. So even now, with the whipsaw action, yesterday's incredible rally and the 100-some-odd% rally that we've seen over the past 3 trading sessions, $46.55. So you think about people who bought at the peak there, they're still underwater. That's why I view this as a lottery ticket, because you don't know who's going to win, but essentially it's like a cage fight at the UFC.
A lot of people still holding who got in sort of much lower, much lower than where we are right now. Amazing story. Let's turn the page to payrolls. The US jobs report at 8:30 Eastern time. The median estimate in our survey calling for a print of 180,000. Becky Frankowitz of global staffing firm Manpower Group writing this: workers are staying put with quit rates holding steady at 2.2%, and we are not rewarding leaving a job as we used to. We're currently seeing a steady-as-she-goes job market where demand is still strong, but softening. Becky joins us now for more. Becky, you've been a good friend to the show over the last few months. It's wonderful to catch up with you. I remember what you said last time around. You said something like this was a Goldilocks labour market. How would you characterize things currently, right now?
Yeah, good morning. I would say this time last year, we were talking about the great resignation. Now we're talking about the great staycation. As employers aren't leaving their jobs, you see that in quits. Employees aren't leaving their job. Employers aren't laying off workers. Layoffs are steady. And we're still seeing pockets of spend, particularly in wallet-friendly experiences, hence staycation. So companies like Amazon, Walmart, Lowe's, we're seeing them move into the top 25. And the new surprise in Starbucks, a bit of an affordable treat coming into the top 25 hirers in our country today. So great staycation.
Becky,
Goldilocks staying put.
You said strong but softening. Goldilocks is staying put. I can tell you that on Wall Street, you've had a lot of guests on this program. They're talking about rebalancing, normalization. They're saying something similar, that we're weakening, but we're not weak. What's the distinction between the two for you?
Yeah, great language. Weakening, but we're not weak. We were all enamored by these huge demand increases we saw post the crisis. And now we're just starting to see that rebalance and steady out. A data point for you, John. On the last show, you asked me about manager hiring. We weren't seeing it a month ago. Now we're starting to see manager hiring increase. Why is that? Because employers prioritize the front line after the crisis, and now they're needing managers to help guide their companies through this transformation. So again, it's a rebalancing.
How do we understand the numbers that we talk about? We're throwing around 175, 180, 200, and then characterizing that as stronger than it was pre-pandemic. So that means that probably that's a pretty robust market anyway. How do we understand that in the tenor of the growth of the labor market and the increase, the influx in some of the workers that we've seen over the past couple of months?
Yeah, so if you're speaking to immigration, Lisa, we have seen new workers come into both from immigration, but also off the sidelines. If you ask me what's the one thing I'm watching today in the report, it's the participation rate, but not in the way that you're thinking overall. Yes, that's interesting. I'm much more interested in the participation by education level. We've been watching for 2 months now the participation decline for those without a high school or college degree. We would expect that to increase as we go into the summer with seasonal labor. That is one I'll be watching for.
You know, so a lot of people are saying, and I'm thinking in particular JP Morgan and Citigroup, that it's not usually linear, these types of weakening. If you've mentioned weakening but not weak, how susceptible is the picture that you're currently observing to some sort of more material downturn? Is that something that you could foresee happening, or is some of this hiring kind of things that have legs that can kind of propel growth going forward in a way that gives you conviction we're not seeing that anytime soon?
Yeah, and I think this is where we get confused in how to translate it and who can see the future. This has lasted longer than I think most people would have expected it to in terms of a downturn. We are seeing softening across almost every sector of the economy, but the challenge is it's softening, but it's still not softer than it was prior. In fact, we're starting to see some similarities to the 2019 labor market, with the exception of the very low unemployment that we're having right now. So I think that that's where it gets a little bit confusing. In terms of your question, where do we see things sticking? Really, we see stickiness in jobs that support IT. The number 2 job in demand in the country today continues to be software developers. The new entrant is the jobs that support this cost-conscious consumer. We're seeing retail stockers, and drivers. So cashiers, retail stockers, and drivers. They make up 3 of the top 5 jobs in the country today. So we do know that consumers, even though consumer spending went down in the first quarter, we know they're continuing to spend on these affordable indulgences or affordable treats to fuel their lifestyle as we go into the summer.
Interesting. Becky, what's the biggest tell for you? What would typically happen in a downturn that isn't happening at the moment?
Yeah, so it's been surprising that we haven't seen the overall unemployment rate go up fairly significantly. It's been stubborn, but the difference in this crisis, John, and what we've seen in the past, whether you go the financial crisis or before, is this pandemic paranoia around employers holding on to their workers. So we would normally see more layoffs happening. The quit rate would definitely go down, perhaps even further than we're seeing now, but we're not seeing that. And I think that's still an overhang of this mentality of I couldn't find workers. Now we're starting to see some signs of normality. Again, manager hiring coming back, things starting to level off, but we would expect a much higher unemployment rate than we're seeing right now in the economy in a normal bottoming out before recovery.
Becky, this was great. It's good to hear from you, as always. Let's do this again soon. Becky Frankowitz there of Manpower Group. Lots in there to unpack there, Lisa. I think the last point is the ultimate point. The post-pandemic environment has been so difficult to read, particularly at the start. Remember, we were printing like 300, 400, 5,000 jobs. Upside surprise after upside surprise for like 2 years, and it just carried on. And a conversation we'd have every single payrolls Friday. When does it stop? Is the downturn just around the corner?
Yeah, well, and I'm thinking about what she said, things like cashiers. Well, do cashiers just have one job, or do people who are cashiers often have several jobs? Are these jobs that are sustainable over the longer term? You talk about AI and some of the technological advancements. Forget AI. You know, some people are wondering about what kind of disruption there'll be in the cashier's land if some of the new technologies get underway. So there's some really interesting trends underpinning this that I think are confusing.
This has been a big, big theme, particularly over the last few years, that we'll try and get into for you. Payrolls, the estimate 180,000. If you are just joining us, that number drops in about 50 minutes' time. The previous number, 175. Equity futures just about turning positive in the last couple of minutes. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Apple is set to introduce a new app called Passwords, allowing customers to easily log into websites and software. The company is planning to introduce the app as part of its latest update to the iPhone, iPad, and Mac software at its Worldwide Developers Conference on Monday. The app will ramp up Apple's competition with third-party apps, in this case with password managers like 1Password and LastPass. Netflix is facing a defamation lawsuit from a woman claiming to be the inspiration for a character featured in the hit series Baby Reindeer. The woman is suing the streaming service for at least $170 million, alleging creators of the show exposed her identity and ruined her life. The show, which amassed 22 million views in just 3 weeks, follows an aspiring comedian who is stalked by a woman. And NBA Commissioner Adam Silver saying the league is looking to expand internationally. Speaking ahead of Game 1 of the NBA Finals, Silver saying this is a consideration as he thinks more long-term, because right now he's busy negotiating TV deals. Currently, Las Vegas and Seattle are looked at as favorites for NBA franchises. The only foreign NBA team at the moment is the Toronto Raptors. That's your Bloomberg Brief. John?
Yahara, thank you. This has got London written all over it, hasn't it?
Yes, no? Very much so.
Isn't there baseball in London over the weekend, I think?
It's ridiculous. Everyone's going to London. Baseball, Taylor Swift. Who else? Who's next?
One of us. We're going to go to London.
And draw that kind of crowd?
The team.
Yeah.
AMH is in Italy, getting ready for the G7. Why shouldn't we be in Europe making that happen?
We'll find something.
We'll find a reason. All right. Up next on this program, counting down to the jobs report.
On trend, it does still look like things are slowing down some. I think that even if we get a little bit of a bounce back today, you're still seeing a labor market that's coming into better balance and cooling on trend.
We're rebalancing. We're back on trend. Apparently it's not weak, just weakening.
Yeah.
Hearing this on repeat this week, aren't we? That conversation continues. This is Bloomberg.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Equities on the S&P 500 just turning green, just about, still unchanged on the S&P, basically unchanged at the close yesterday as well. Very close to all-time highs, Lisa, going into this one.
Why would anyone trade ahead of this?
I know.
I mean, honestly, it's sort of like, you know, casino's closed, let's hear it, all the chips in, and on to you, 8:30 a.m.
Can't you say the same thing about CPI Wednesday? Like, why do anything over the next couple of days?
Well, algo's going to algo.
True. Okay. It kind of ruins the vibe, though, doesn't it?
Well,
when it's just like,
I mean, it's true, but this is the problem, okay? Is anyone going to materially change their view? It could. If it's sub 140, you could get a real change
Sub
in view.
140, which is Holland Horse cool over City.
You get below
Sub
that,
140.
all of a sudden that changes the mood music and there is real trading.
Stuart Kaiser says that will be worrisome going into the Fed next week. Under surveillance this morning, counting down to the jobs report.
On trend, it does still look like things are slowing down some. Whether it's the unemployment rate that's ticked higher or the U6 underemployment rate that's creeped up about a percentage point over the past year and a half. Obviously, you saw it in job openings and other data this week. So I think that even if we get a little bit of a bounce back today, you're still seeing a labor market that's coming into better balance and cooling on trend.
Here's the latest, less than 1 hour away from the May jobs report. Ellen Zentner and the team at Morgan Stanley expecting payrolls to rise 220,000, above the median estimate of 180. The team writing this, we expect some slowing in labor demand over the course of the year because of the ongoing gradual downtrend in job openings. However, there's no immediate sign of strain. Ellen joins us for more. Ellen, one of the best. It's good to see you, as always.
Hey,
the difference between weakening and weak. What is that difference? We had that conversation moments ago. What's that distinction for you?
Weakening and weak. So weakening is slowing.
Weak would be sort of a consistently below the level that we would consider sort of we use this term break even, the level at which you need to create jobs each month to keep the unemployment rate steady, right? But weak has taken on a whole new meaning in this labor market because we think you need to create around 250,000 jobs to keep the unemployment rate steady. Now, does that mean weak number is anything below 250? There's uncertainty around a range around that break even, but certainly 150 would be a weak number.
Do you buy into this rebalancing story we've heard so much about this week?
Yeah, so the rebalancing is everything always, you get worried when it feels like there's a turning point. Is this a turning point? I mean, we've had false starts of a feeling of a turning point before. Things are slowing, and they're slowing globally, and they're slowing in the U.S., but is it a significant slowing, or is it a slowing that would just be sort of what you would expect, given that Fed interest rate policy is working? And besides the employment report today, we do get important data from the Fed around noon on borrowing, and borrowing is slowing, and Fed rate hikes are having an effect. And I think we're past the point of discussing whether they're actually having an effect on the economy or on the labor market. And now, just within the last week and a half, it feels like investor conversations I've been having is, oh my gosh, is it slowing more than we think? Is it slowing so much that the Fed is actually going to get started in September, maybe even earlier?
Where do you fall on that camp? Because what we heard from JP Morgan's Priya Misra and from Neil Dutta of Renaissance Macro is essentially if the Fed doesn't cut next month, it will be making a policy error. Do you agree?
Yeah, so I think that we're seeing the bets of cutting next month rise because it's a pretty cheap trade to put on that the Fed may actually go in July. Even if they don't go in July, does it push people further toward July? If we get a weak number today, if we get a downside surprise to CPI, absolutely, it raises the probability they go in July, but I think the bar is insurmountable for July. I think what it does is make it pretty apparent that there would be messaging that they're ready to go. And I think, we've had a long-standing call of 3 cuts this year. I know the market still isn't there, but I do still expect that they start in September and go through to the middle of next year.
You've also had a soft landing conviction call, that you've thought that this would be a soft landing. You raised the point that a lot of people have been surprised at how quickly the weakening has been happening. It's a little bit faster than people previously expected, and it's been accompanied with also fewer immigrants, actually. You're seeing that some of the immigration numbers come down, in particular to the labor market. It's been one of the offsets to some of the increase in average hourly earnings, et cetera. Have you gotten less conviction around the soft landing?
No, not at all. But let me just preface this, and one reason why people dislike economists is because a soft landing is there a positive sign in front of GDP? But we've had the soft landing call since early 2022. 2022, that's a long time for the same call. But it's just been a matter of what's the positive sign in front of GDP? How positive is it, right? I have no recession call on the table. Now, that doesn't mean that there are not risks that abound. Obviously, in an election year, anything that changes immigration materially can provide a lot of downside pressure to the economy because immigration flows, those flows into the labor market have been so supportive of economic growth. And so naturally, with the presidential proclamation intended to slow immigration at the border, and we've already seen immigration flows slowing, that's naturally raised questions and sort of gotten investors thinking about, could we see a real slowdown here? I will say that when these policies come about, we tend to jump immediately and assign them as perfectly implemented, perfectly effective. So yes, perfectly implemented, perfectly effective, you would slow the rate of inflow into the country quite a bit, and you'll slow the rate of inflow into the labor market, which has been hugely helpful at a time when we cannot talk about immigration because it's the second greatest concern among voters. But it has been hugely helpful to the economy.
A big feature of your outlook has been bigger, not tighter, bigger, not hotter. If you did get that change, how would it change your outlook? I'm just thinking about the way your cuts are lined up on the calendar, September, November, December. Some people have come on the show and said quite seriously, Ellen, that that's not possible because of the politics. How do you feel about that?
Yeah, so the Fed is not political. I think Chair Powell has done a really good job of tamping that down. Look, the Fed has to be patient when they get asked these questions because, hey, the 1970s, right? So we did have political pressure on the Fed and they responded. But this is a body of 19 people. We are at full capacity on the Fed, the FOMC, 19 people with varying degrees of political views, and all 19 that have a strong sense of civil service. And it's one reason why I always feel more comfortable when decisions are made by committee. And so you could argue that if they cut in September, it looks political. You could argue that if they don't cut in September, it looks political. I think what they will do is make sure that the data firmly supports cutting. And one message you're going to get from Chair Powell, which I think folks have sort of glossed over, that he said before blackout, is that this is not about the year-over-year rate of change in inflation. It's the sequential monthly pace. Because the year-over-year rate, think about how fast the deceleration in inflation was last year. We're about to comp to that. And it's going to keep the year-over-year rate very high. This is about sequential pace, and it is coming down.
How much has what's transpired over the past few months changed your view, not just about this year, but next year, about 2025, at a time where there are a number of people who are debating whether or not it's just going to be a shallow kind of cutting cycle or something that goes more deep, the Citigroup side of things. Have you shifted your view at all?
So what we did was, we have shifted our view out from June, right, expecting them to start in June. That was our view last year, was that they would start in June this year. So that has shifted out to September. We did, though, shifting it further out, it put you further into the area where we've got month-over-month core PCE coming down to 0.2% and then below 0.2%, which starts to get consistent with their 2% goal before we even hit the end of the year. So what we did was go to cutting at every meeting. So where we had them being very gradual and cautious, this is simply dropping rates in line with falling inflation. You don't need to be as restrictive. So it's not easing policy, which is a very difficult message for the Fed to sell, right? You're cutting, you're not easing. And so dropping rates in line with falling inflation has them cutting every meeting, but we have them stopping at the middle of the year. So we have them stopping earlier than we had them before. And so 3.5% funds rate, not far off from where consensus is, but consensus has them getting there at the end of the next year. We have them getting there in the middle. And then I think clients really have to think about where do they go from there. I think Powell can be very nimble around the incoming data. I think you're going to get a game of cat and mouse with the Fed, with the housing market responding very strongly to lower rates, and they could be holding and then hiking again.
Interesting. That's quite a call. Ellen, thank you. It's good to get your perspective as always. Ellen Zender there of Morgan Stanley. 2025 is such a difficult call.
Oh my goodness.
With that 9 November.
I mean, from rate hikes to cutting at every meeting until mid-year, and then the cat and mouse game. I love that. That was put so well about the market
super
and the response to cuts.
Super tough. In the next hour, counting it down to payrolls with Nadia Lovell of UBS, the former Fed Governor Randy Kroesner, and reacting to them with Jeff Rosenberg of BlackRock and Mohammed Al-Arian of Queen's College, Cambridge.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Welcome Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Suppose the unemployment rate goes up, but job growth stays strong. That's sort of a perfect scenario.
I think we are going to a more normal, gradual pace of job creation.
We should be talking about the other risk. Employment could really weaken.
I don't think 150 would be such a bad number.
The soft data has been telling us that the economy stinks. It's the hard data that is actually going to move the needle.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
We've been anticipating this number all week. The wait is almost over. The number drops in 30 minutes' time. Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now. You should know the numbers already. If you don't worry. Here are the guesstimates. And I think the emphasis on guesstimates. 180 is the median guesstimate in our survey. The previous number, 175. 3.9% unemployment, set to stay below 4% all over again. Had plenty of opinions over the last week. We've talked about Andrew Holmhorst's city a few times. There's a reason for it. He thinks this Fed cuts rates in July. Here's the line that just dropped from Andrew going into this number, Lisa. We expect a further slowing in employment data. 140,000 is their estimate for May. Unemployment rate rising to 4%. This would be the most important factor in share power, leaving all options for rate cuts on the table next week.
Well, I think JP Morgan would agree. That's what we heard from Priya Misra, that essentially right now the labor market has taken on an increased emphasis over even CPI that we get next Wednesday ahead of that rate decision. I will say what Morgan Stanley's Ellen Zentner just said, I think is really important to highlight. Our understanding of what these numbers actually mean. She said that 250,000 is what you need to keep growing at the current level, to keep unemployment at the current level. So that frames out some of these numbers a little differently than, say, just looking at historical precedents.
It's been a go-to question for us all week. What is weak? What is weak? When they say we're weakening, but we're not weak, what is weak? Andrew Holmhorst is pointing to 140. Citi Stuart Kaiser said anything below 150. I think Bank of America was at something like 125. That's going to be a conversation potentially we have in 28 minutes.
I also, and I know that some people say this isn't that important, revisions do matter though
Of
also
course.
because they've been messy and we've seen a lot of downward revisions. We saw the weakest growth in 6 months last month, granted at 175,000, so it's been pretty punchy anyway. If we get that revised significantly lower, could that shift the needle even if this is an inline print? That to me is a legitimate question.
And I tell you, and we've said this repeatedly, it doesn't matter what that number is. At 8:31, those debates won't change. They'll continue into next week. CPI Wednesday morning, right before that Federal Reserve decision, a news conference with Chairman Powell, and a set of projections as well. And in those projections, they've got to say something about 2025. And if you ask me about 25, I'd put my hands up and say, I think 2025 is impossible to forecast without knowing the outcome of November.
We had Adam Posen coming on of the Peterson Institute saying essentially he expects a rate hike maybe next year just because of some of the policies that could come through that are quite inflationary. Ellen Zentner saying they might cut at every single meeting to 3.5% by mid-year, which is the consensus by year end. But on the flip side, that might be where they stop. And then the next move will be a hike because of some of the economic and, frankly, market-based activity that generates. You start putting this together, a lot of it depends a lot on those policies and not just what they are, how they're implemented, which also will not be decided for quite a bit.
It's quite a week coming up, quite an hour as well. Before we get to the weekend, we've got to deal with this. Coming up on this program, Nadia Lovell of UBS on why she sees equities grinding higher, former Fed Governor Randy Krosner on why he sees a slowdown coming in the fall, and Mohamed Al-Erin on why he's hoping for a July rate cut. We begin with our top story, the payrolls report out in just under 30 minutes' time. Nadia Lovell of UBS staying bullish, writing this: we believe the macro environment remains favourable for equities with gradual cooling of the economy and labour market. This, along with easing financial conditions as the Fed cuts rates, will push equities to new highs. Nadia joins us now for more. Nadia, you believe the Fed put is in play. Why do you still believe that maybe that weak data isn't bad news? It might be good news.
Yes, you know, the Fed put remains in play. It is, even though we saw in the meeting minutes that there are some participants who would be willing to raise rates if the data warrants this, and there's ongoing debates about the restrictiveness of policy. We do think that policy is restrictive enough, and the bias is to the weak data, particularly in the payroll data. So if we see any sort of weakness in the labor market, the Fed stands ready to be able to adjust monetary policy. I mean, our core view is that we're still looking for 2 rate cuts starting in September. We've been at that for quite some time, and we'll see what happens next week. We could see a downgrade to 2 cuts in the SEP and the medium dot. That's what we expect. But you could see it go down to 1. It all depends on what happens with payroll and CPI. There's a narrower margin, but we think that the Fed would want to maintain that optionality for a September cut. And at the end of the day, the futures market is sort of already there, been oscillating between 1 and 2 cuts since April. As of this morning, it's at 2 cuts. So don't expect any major surprises in terms of reaction from the market around that.
Nadia, what about this morning could possibly, potentially change your mind?
You know, I think this morning, if you see, it's becoming more difficult, as you know, to predict the market's reaction around any sort of single macro data points. If you see payroll comes in very strong, I mean, some of that market reaction could get faded next week, depending on how CPI comes in. If CPI comes in hot, because it could change the Fed's reaction function. So we think that the sweet spot for the labor markets is probably in the mid 100,000 to under 200K, and no sort of increase in terms of average hour earnings, just given the sensitivity around inflation. And we think that we'll probably get something around that in that sort of 150 to 200 range, and that should be enough to keep the market cool and continuing to move higher, focus on the fundamentals that are picking up on the earnings side.
Michael Hartnett over at Bank of America has been kind of harping on this point for a couple of weeks now, where he's saying that if there is some sort of rally in the bond market going forward on the heels of weaker data, it's going to be actually negative for stocks, that this is actually a bad sign. Why do you disagree and think that actually that would be supportive?
I'm not necessarily completely disagree with that. I mean, just look at the performance of the S&P over the last couple of weeks. While we're notching new highs, I mean, that is mega trends, right? Not necessarily the cyclical components of the market. You're seeing the market breadth has gotten narrower. You're seeing about just 25% of S&P 500 companies that are outperforming an index on the year-to-date basis. And a month or so ago, it was closer to 40%. And why has that weakened? It's because the data has been coming in mixed. And so even though you've seen a pullback in bond yields, it is not because inflation is coming down or people are on the disinflation bandwagon. It's more because the mixed data coming in on the growth side. And so that's causing a bit of a volatility in sort of the non-mega trend areas of the market. So that's why I wouldn't completely disagree with that sort of any sort of weakness that we're seeing on the macro fronts wouldn't necessarily be a negative for the market.
It's an interesting kind of question, especially at a time where a lot of people have been betting, frankly, for the past 6 months that there'll be a broadening out from just big tech, and that you'll see this sort of, a rising tide lifts all boats, and now it's a rising tide lifts one boat, and that's NVIDIA. How much do you really buy into this sort of broadening out trend, especially given the fact that we're seeing a retrenchment of that and only a consolidation in the names that have been winning?
Look, we have to continue to react to the data. Yes, you are seeing some parts of the economy slow, but it's not fallen off of a cliff. And I think that once we get, second quarter GDP numbers, and once we hit the earnings season, again, we did see a pretty solid first quarter earnings season. And we think the second quarter earnings season will also be a good one. And that will give the market a bit of a confidence in the sustainability of the earnings. What we need to see also is on the manufacturing side of the economy. As we know, the S&P 500 earnings are more geared towards the good size than the service size compared to where the economy is. About 50% of earnings are more coming from goods, and in the economy is closer to, a third of the economy is driven by the good side. So if we can see a pickup in PMIs and more sustainability there, we think that you will, because when you look at inventory is pretty clean and lean compared to where they were post-pandemic. And so we do think that new order growth can pick up. So if that can come through in the second half of the year, that could help the market get a cyclical build. But we do, at least as I noted earlier, that we think that ultimately these mega trends, we're less focused on sort of these sectors and more focused on some of these mega trends around AI, around reshoring, around energy transition, around healthcare in terms of diabetes and obesity.
Raised a question we asked a little bit earlier this morning, Nadia, worth repeating to get your response to it. Just how relevant is jobs, the outlook for the Fed, to the mega trends that you're discussing?
It's not as irrelevant longer term. Yes, you can have some, knee-jerk reaction, and we think that itself, in terms of sort of sensitivity to the downside, that itself we think is an opportunity, because when we look at these megatrends, we think that these are going to be multi-billion to trillion-dollar opportunities over the next decade, and we think that there's still more to go. It's not just a one stock story. NVIDIA continues to dominate the market over the last couple of weeks, but the spending increase that we're seeing in the build out of data center, the CapEx investment that's happening there, that is being spent across data centers. That's being spent across utilities, that's being spent across industrials. And so we do think that there's a longer term opportunities there, and we would use any sort of pullback and disconnect in the market to add to these exposures.
So in other words, just to sort of wrap that together, are you basically saying that you could see this stock market continuing to climb even if there is a material downturn in the labor market, akin to really something that's more like a downturn more significantly in the economy because of some of these secular megatrends?
And you're seeing that over the last few weeks. I mean, in terms of, 22 new highs year to date, and then a couple of them just coming in the last week, couple of weeks. And a lot of that is being driven by these mega trends, and including, as well as diabetes and obesity. It's not just AI, even though AI is the most dominant trend. So that's how we're investing for clients, and less focus on some of the, cyclical aspect. We do layer in cyclicals as we think that will ultimately start to catch a bit in the second half of the year. But again, the undercurrents of these mega trends have staying power, and we think are quite powerful.
Nadia, as always, thank you. Nadia Lovell of UBS. Appreciate your time, as always, going into payrolls on Payrolls Friday. That number about 20 minutes away. We've asked that question a few times, haven't we? Does it really matter to NVIDIA how many jobs get printed in about 20 minutes' time?
The answer, probably not. The only way that it possibly could is if advertising spending goes down, and then suddenly the big four companies that have been buying all of those NVIDIA chips in bulk might buy less of it. But that's, again, that's a lot of steps to get there.
This goes back to the Mandeep Singh point, right?
Yeah.
Of Bloomberg Intelligence. Just how long is that runway for some of these names? I guess we'll find out. Ultimately, we always do. Equity futures right now on the S&P. I know that's not helpful, forgive me. On the S&P, we're positive by about 0.1%. The jobs number just around the corner. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. President Joe Biden announcing a new $225 million aid package for Ukraine during a meeting with his counterpart, Volodymyr Zelensky.
We're not going to walk away from you. I apologize for those weeks of not knowing what's going to happen in terms of funding, because We had trouble getting the bill that we had to pass that had the money in it from some of our very conservative members who were holding it up.
Biden met with Zelensky in Paris ahead of his state dinner with French President Emmanuel Macron this weekend. Shares of GameStop whipsawing in the pre-market, the company announcing it may sell up to 75 million Class A shares and plans to use the proceeds for what it says are general corporate purposes. The news coming alongside disappointing first quarter results and ahead of a YouTube live stream by Keith Gill, known online as Roaring Kitty, whose social media posts have sent the stock soaring over the past week. And Porsche shareholders are calling on the luxury car maker to ease off EV plans. At the company's annual shareholder meeting, CEO Oliver Bloom was asked why he's sticking with a goal for plug-in vehicles to make up more than half of sales next year. Investors point to slowing sales in China and rivals walking back EV expectations. The automaker still aims for all-electric models to account for more than 80% of sales by 2030. That's your Bloomberg Brief. John?
Yahara, thank you. It's another one, Bramo. It's another one.
Yeah, and the interesting thing is, you've pointed this out, that it's not necessarily a wholesale revision of the ultimate goal, but it's saying that the pace has been way too fast, and we hear that again and again.
Way too fast. Just a long list of news items through this year that speak to that theme. Equities right now on the S&P just about positive. Up next, the Morning Calls Plus. Former Fed Governor Randy Krozener as we count you down to the May payrolls report. It's 16 minutes away.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
The payrolls report, 8:30 Eastern Time. Going into it, the scores look like this on the S&P. Been treading water all morning. We're just about positive by 0.05% on the S&P. I know, nail-biting stuff, right? Yields up by a single basis point, 429.86 on a 10-year. No drama this morning on this board. That's all going to change at 8:30 Eastern Time. Let's get you some morning calls. First up, JP Morgan downgrading Vail Resorts to underway on the back of disappointing earnings. The analyst noting headwinds including trend normalization as season pass unit sales slow down. That stock is down 7.4%. And next to me is Bramo nodding her head repeatedly.
Well, it was tough with the snowmaking and the different kind of whipsawing temperatures that made it really difficult for a lot of resort resorts, particularly in the Northeast.
Your next story. This is personal for Lisa, not this one. Bank of America double upgrading Lyft to buy with a $20 price target. The analyst highlighting the ride-sharing company's first ever investor day, upping confidence in the company's long-term trajectory. That stock is up by 3.25%. And finally, Truist downgrading Exxon to hold. The analyst noting the Pioneer acquisition as a positive addition, but forecasting stock underperformance thanks to near-term valuations. That stock a little bit softer. We're down by 0.4%. The payrolls report, just moments away. The median estimate in our survey calling for 180,000 jobs added in May. Unemployment expected to hold steady. Former Fed Governor Randy Kroszner joins us now for more. Randy, always great to get you on the show on Payrolls Friday. What's the big focus for you going into this one?
Well, once again, it's going to be on where are wages going, because I think the Fed is really laser focused on that, because wages and employment costs are the most important input into all production processes, whether they're services where it's the vast majority or manufacturing where it's still an important piece of it. And that's going to have a big impact on costs, on prices, and where inflation is going to go.
Randy, we spoke to JP Morgan's Priya Misra earlier this morning, and she said for the market, specifically for the market, this number this morning was more important than Wednesday morning's CPI print. How do you think that one stacks up for the Federal Reserve? Which is the more important number?
I'm going to give you the economist answer. It depends. It depends which Fed person you're speaking to. Some people focus on much more on the inflation, the actual inflation number. Other people are looking more at the labor markets to see where inflation is going to be going. You really have two different camps at the Fed right now. You have some people who are kind of looking for any excuse to say, we better be cautious. We don't want to have inflation take off again. And others are saying, gosh, it does seem that there are signs of weakening, and so they'll interpret whatever data come out and sort of we need to be moving sooner rather than later.
Which speaks to our frustration, because there are people making arguments on both sides of the camps, and they're both completely logical and make a lot of sense. We've got some like Adam Posen saying that it would be a mistake to cut rates, and that next year the Fed may have to hike rates again, depending on the policies that are implemented later this year. And then you have the likes of what we heard from Priya Misra, what we heard from Neil Dutta over at Renaissance Macro, saying that it will be a policy error if the Fed doesn't cut next month. Where do you fall on this?
So, I mean, obviously we've got to see what the data will say, and that's going to inform the decision. I can see why the Fed's hanging tough where they are. I mean, you've got that burden of history of what happened in the early 1980s when they moved too quickly, lost credibility. That's the last thing they want to do. And so my guess is if they're going to lean in one direction or the other, they're going to lean towards caution before cutting too quickly. They're not going to do what the ECB just did and sort of do a quick cut and say, well, inflation's still rising, so we better not move anymore. They're going to wait until inflation is actually coming down in a way that they feel is sustainable before moving. Now, that could mean that that risks more, that has more of a downside risk to it, but I think they're willing to make that, or the consensus, I think, will be willing to make that trade-off.
We were talking about that earlier, how there is no chance that that kind of statement can come out of the Federal Reserve, akin to what we heard out of the ECB yesterday. I am curious, though. We've heard from the likes of Peter Scheer that he sees a greater likelihood of July rate cut because it gets the Fed out of the crosshairs of being accused of political interference or some sort of manipulation ahead of the election, even if they cut only the same number of times this year. How much would you really push back on that?
I think it really depends on what the data are saying. If the data are really clear, they'll cut. So if we get a weak number now, weak number next month, and the inflation numbers are coming down, then that provides a sensible basis for them to move. If we continue to get reasonably strong numbers coming out on the labor side, reasonably strong wage growth, and inflation just kind of stubbornly kicking along where it is, not really, maybe moving just really baby steps down to their 2% goal, they're going to wait.
Randy, you've been at the FOMC and witnessed turning points, big turning points. This feels like a turning point. We've got a lot of guests around the table talking about rebalancing, normalization. These are all phrases we've heard on repeat through the week. What we're trying to understand is what would guide you, a former member of the FOMC, to really understand where this was going, whether it was about rebalancing or whether it was about going somewhere darker. What would you point to? What would be guiding you?
So, as I said, I'm going to look at wages. Obviously, we're going to look at the strength of the labor market, and we'll also be looking at things like quit rates. So, how do people feel about where the economy is going? We'll also be looking at we'll be getting a GDP update to see where overall activity has been, and so I think those will be some of the things to be looking at. And then, of course, core inflation, because core inflation probably has the core personal consumption expenditure index, that the PCE rather than the CPI. That tends to have a little bit more information about where things are going. By no means perfect, but those would be the key things I'd be looking at. But certainly, I wouldn't be making any move right now.
Randy, appreciate your insight, as always, particularly given your experience. Randy Krosner there, former Fed governor, waiting for the data like the rest of us with no real conviction about where this is going.
Well, and this is sort of the argument that Mohammed has been talking about for quite a bit, Mohammed Al-Arian, which is you kind of have to have a framework. And it seems like nobody really does have a framework because we don't know where we are. I mean, we talk about the frustration of how confusing this is. We won't know until it's too late whether the Fed is behind the curve or whether they went too fast. We just won't know. And that's just going to be where we're at.
We'll know the outcome of May very shortly. It's 7 minutes away. The table's stacked. Mike McKee's in the room, logged on, ready to go. Mike, what are you looking for, buddy?
You know, it's funny. I come in here every month and I say, this is not a particularly exciting number. It's not going to change a whole lot. And you give me a side eye. Yes, this one's going to be much more interesting because there are a lot of factors at play. And I even made an under-the-hood checklist for you here. First thing we're going to watch for is seasonal adjustment factors, because May is one of the biggest volatile job months. You get all the teachers who leave the payrolls. You get all the kids going on to part-time jobs or summer jobs, and the non-farm payroll seasonal adjustment usually pushes the rate down significantly. The whisper number versus the forecast, first time we have seen Wall Street think that the number will be smaller than the economist forecast since last November. 168 is the whisper number. Average hourly earnings calendar quirk. This week, the survey for the May week didn't end till the 18th, so there was an extra pay period in there that could influence pay higher. Hours worked. If the economy is slowing, we should see hours work click down. The forecast is for no change. There was an earlier this week forecast. It might go up. And then how many people are working for part-time reasons? That number has been quietly going up for economic reasons. And that's a number that goes up when we start to see a real slowdown in the economy. So there's a lot of things to watch under the hood here.
I want to pick up, I love this. I love the checklist, the under the hood checklist. Big fan. And I'm wondering about the point that you just made, and I think it's a great one. This is the first time that the whisper number has been below the consensus going back to last November. What does that tell you based on what we've seen in terms of upside surprises, in terms of sentiment and expectations heading into this?
I think what we're seeing is Wall Street's buying into the slowdown story and buying into the idea that the Fed might be cutting rates sooner. And we've seen that in the trades in various asset classes. But I would point out as well, this is the first time since last November, but Wall Street and the consensus were wrong last November. The number came in higher than both. So we could go anywhere here.
We've said this a few times. It doesn't matter what this number is in 4 minutes. These debates will rage on, and we could get whipsawed in the other direction when we get CPI. Wednesday morning, going into the Federal Reserve. The jobs number is coming up next. Mike McKee's breaking down that number for you. We'll break it down with Mohammed Al-Arian of Jeff Rosenberg as well. The number you were looking for in our survey, 180K.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Here it is, 25 seconds away, the jobs report just around the corner. Here are the scores for you going into that number. Equity futures just about positive on the S&P 500 by 0.02%. In the bond market, turn a page, we look like this on a 2-year, 10-year, 30-year. Your 2-year yield, 472.95 and unchanged on the morning. The 10-year, 428.31. The number we're looking for, 180K. With the number, here's Mike McKee.
Well, we got a little bit more than we expected. 272,000, which explains the no ties. You'll understand in just a moment. Change in private payrolls up 229,000. The unemployment rate, though, rises to 4%. We'll break that down in just a second. Average hourly earnings come in 0.4 instead of the 0.2 last month, 0.3 forecast. We talked about that in the under the hood checklist, which pushes average hourly earnings up to 4.1%, a 2 basis point move up from 3.9 the prior month. Average hours worked, 34.3, which is unchanged. So doesn't look like there's any kind of change in the economy. Now we got some revisions here to look at. The total payrolls for the month of April, 165. That's 10,000 less than initially reported. And we've got 4% for average hourly earnings on a year-over-year basis last month. So it's only a tick up from that, but a lot more strength than anticipated. The total net payroll revision, 15,000 for the months of March and April. John, I'm sure this one's probably getting people's attention.
Yeah, that was the door shutting on July. That was that noise just then in the last 90 seconds or so. Goodbye, July. Here's the equity market on the S&P 500. We're negative by 0.4%. On the Russell, we're down big time, off by more than 1 full percentage point. In the bond market, here's the move, and we'll sit on this move. The 2-year yield with a double-digit move in the other direction, up by 11 basis points and back to 483.85. On a 10-year, up by 11 basis points to about 439.42. You've got to think about where we've been. A week ago, this 10-year was in the 450s. Then we had a string of weaker than expected data taking us into the 420s. We're turning that story around at the long end of the curve on a 30-year. The 30-year is back to basically where the 10-year was last week, 451.85. Yields are up there by about 8 or 9 basis points. Once you've seen that screen, you know what's happening next in the FX market. Switch at the board and get to foreign exchange and take a look at the euro. Through 109 briefly, we gap lower by 0.5% at 108.37. The attention, Bramo, monster upside surprise on payrolls. The attention as well on a hot wage print.
All right, I'm sorry to everybody because I slammed the table. I was so surprised to see these numbers. Honestly, it came in all the wrong ways for the Fed, especially with wages coming in higher than expected and unemployment coming in a tick higher. This is a confusing kind of read at a time when we're supposed to be seeing a slowdown, but what this does is it does take off the table a July rate cut. And it raises a question, I think, to Ellen Zentner's point. What are the numbers we should be looking for with a true slowdown or expansion? What does this imply for economic growth? Because it's getting noisy out there.
So the Federal Reserve would say, we're looking at the totality of the data, right? That's what they'd say. Mike McKee, can you reconcile these numbers this morning with the data we've heard all week?
No. You can maybe some of the consumer confidence numbers that went up in the last month. But at this point, the ISM readings were lower. Obviously, jobless claims back in the survey week were still low. So this is just an ongoing source of strength. Now, the interesting thing here is that the labor force fell significantly during the month, which tells you that maybe this wasn't a story of a lot of immigrants coming in, 250,000 lower in the labor force. The unemployment numbers in the household survey come in up 157,000, and the employment number down 408,000. So a significant difference between the household and the establishment surveys, and I can see tinfoil hats being donned on both sides of this conspiracy that's about to be hatched, that there's something going on here. We do get a lot of volatility in the household numbers, so I don't know, it was only 25,000 gain last month, and now 408,000 lower. So it's either payback or there's something different between the two things we're going to have to look into.
Lisa, quick reaction from Stuart Kaiser over at Citi. Very strong payrolls and upside to wages, so less recession risk. But we need to talk about inflation again. Question mark. Question mark.
That's really the key question. What I find interesting is the stock market reaction. Talking about Stuart Kaiser, he was talking about how good news is good news. Well, is this good news? Because it looks like a really hot print, which means that there's more employment, and that's positive for growth. So why are stocks down? Right? This isn't good news for equity markets. Even the S&P 500, yes, the Russell 2000 in particular. People are not taking this as a robust economy. They might be taking this as inflation running hot. It's not being read through as good news is good news, because this means that growth is going gangbusters.
Well, it's all relative, and we both know with experience that these moves on the screen may or may not stick for the rest of today. But let's start with the bond market. If you pull up the screen, look at the bond market, the 2-year, 10-year, 30-year, and where it is right now. And let's start with the 2-year. We've had a move of 14 basis points at the front end. On a 10-year at the moment, we're up by about 14 basis points as well. If I'd showed you that, and then showed you this, equities down 1/3 of 1% on the S&P 500. It's not a big move on the equity market, to be fair, is it?
No, and it's driven a lot by the consumer cyclicals, because you do have people who are getting certainly hurt by higher rates where they are. That said, it raises a question about how much dynamism there is. And shouldn't you see a broadening out in some of the equity performance if you really buy into this idea that the expansion is really mid-cycle or something akin to that, and that it can keep going even with rates where they are? A lot of questions. Very difficult for the Fed to know how to parse through this, especially at a time where they want to cut rates, where they are worried about the tail risks to the employment market, at a time where the data is not giving them that open door in any way.
If you're just joining us, welcome to the program. So the headline number 272 against an estimate in our survey of 180 for wage growth, average hourly earnings month over month. We were looking for 0.3, we got 0.4, and the year-over-year figure has a 4 handle. It's 4.1%. Mike McKeeve had a bit of time to go over this one. What jumps out now for you?
Well, it does look like there was a big seasonal effect on the total non-farm payroll numbers, because there was 917,000 jobs created in the month of May, according to the non-seasonal numbers. And so that comes down to 272. And we've seen that in the past. But in this case, the number was so big that it didn't push us into the kind of down numbers that people were expecting. Manufacturing payrolls up by 8,000 during the month. We had seen a 40 handle on manufacturing in the ISM, so that suggests that maybe there's something wrong with the way people are responding to the ISM numbers. The retailers only 13,000, but they're still hiring, so maybe consumers aren't going away. Construction, 21,000. This is an interesting one, because it was only 0 hired in the month of April, according to the revised figures here in construction. And there was some talk that maybe they were running out of workers because the number of immigrants coming into the country, even illegally, was dropping over the last couple of months, and a lot of them end up in construction. So there's a lot of things in this number that are interesting to look at. Government numbers were up significantly. Federal government up by 4,000, but total government, state and local, 43,000. And yet there were big layoffs in the non-seasonally adjusted numbers for teachers. So the seasonal adjustment factor is working in the favor of a higher number.
Mike, stay close. We've got a lot to talk about. Let's get to the panel. Joining us now is Mohammed Al-Erin of Queen's College, Cambridge, alongside BlackRock's Jeff Rosenberg. Gents, great to catch up with you both. Mohammed, first to you. You've had a bit of time to pore over this one. What's the big one for you?
So I like to look at this in 4 ways. One, the very narrow sense. This is a really strong report on the demand side, not on the supply side, on the demand side, but strong in terms of demand for employees, strong in terms of wages paid, etc. It does close the door on a July rate cut. I think that is it, almost regardless of what the CPI number says next week. But then step back and ask the question of reconciliation with other data. And then the story gets a lot more interesting. We have the situation where the backward-looking data is strong, the forward-looking data is weak. So we've got to sort of reconcile these two things, which leaves us to the point that Lisa raised, which is, what is your view of the economy? Because if you don't have that view, you're going to continue to get whipsawed for quite a few months, and you're going to miss windows of opportunity that are really important.
Yeah, Jeff, this is really difficult. It was a question we both asked Mike McKee. Can you reconcile this data this morning with the data we've had all week? First of all, your view on this morning's number, and second of all, to Mohammed's point, can you reconcile this with what we're looking at elsewhere?
Yeah, a couple of things. I mean, the big market reaction is not only because this is a strong report on its own, but it is stronger than what people were expecting going in. And there were two things that were kind of undermined relative to those expectations. Number one, as Mike was talking about, the seasonal flows expected to push down. We overwhelmed those. And then there was a pull forward argument around warm weather, and the construction number that Mike just mentioned was very strong. So you didn't see either of those things. Mohammed mentioned closing the door on July, opening the door or reopening the door a little bit wider on the debate about whether or not policy is indeed as restrictive as the Fed thinks it is. And this is a little more evidence to bring that debate back into the fore, that you have the big financial conditions easing that's offsetting the tightening. And we may not be as tight as we think we are.
Mohammed, I'd love your thoughts on that at a time where your framework does expect some more significant weakening. Does this data change that to you? Does slamming the door on a July rate cut seem reasonable to you, or are you concerned that this is basically the wrong signal at a time where what comes next looks different than what came before?
Look, it's reasonable for a Fed that is overly data dependent. There's no way they can cut or signal a cut in July with this data. They would have to change their reaction function and be public about it, and I don't see the Fed doing this. So that's why the door is shut. Now, should it be shut is a much more interesting debate. You know my view. We are in a weakening economy. There are no spare tires to speak of anymore. There's no pandemic savings. There's no huge new fiscal impulse coming. There are no spare tires in this economy. So if you get it wrong and you weaken too quickly, it's going to be a very difficult mistake to correct. The problem is, which is the other bit of my view that you know, is we are living in a secularly inflationary world. Secularly, inflation is going to be higher because of all the transitions going on domestically. We no longer talk about liberalization, deregulation, fiscal prudence. We talk about trade restriction. We talk about industrial policy. We talk about fiscal irresponsibility. And globally, we talk about fragmentation. All that means a more inflationary world, which then raises the question as to what should be the right inflation target. So if you put all this together, it does shut the door for this Fed, but it will not shut the door on a very active debate that's going on that tries to look forward, not back.
Well, we'll get to Jeff in 1 second, but Mohammed, just to follow up on that, are you basically saying that the chance of a harder landing increases the longer the Fed does not cut rates, even if it appears strong on the surface?
I do, because I focus a lot on the forward-looking data, and that is weakening significantly. So yes, that's where I am. But I understand that if you're data dependent, there's no way you're going to come anywhere near my view, because you would have to completely change your paradigm.
Jeff, would you agree with that?
Well, I think there's a little bit of a segmentation going on in terms of where is interest rate policy biting. And it is in the lower end of the consumer side. The flip side of that is the wealth effect, right? This is a Fed that has basically said, if inflation is stronger, if growth is stronger, we'll just wait. They've given us a very asymmetric outlook with regards to their reaction to their data dependence. What that has done is basically given the green light for financial market conditions to be very easy, and the transmission of that into the economy is a very strong wealth effect for the predominant sources of where most of consumption comes from. So you do see the weakening that Mohammed's talking about, but the weighting of that weakening, I think, is less. And so, yes, growth is slowing, but it's slowing to a level that is still well above trend. And so you don't get as much of the constraint and the push down on inflation. The Fed is basically saying, we're okay with that. And I think that's why you're pushing back with this data today on this notion of we're really restrictive. I'm not sure they're as restrictive as they think they are, and the policy of asymmetry to data reaction is kind of pushing against that by pushing up or easing financial conditions.
If you are just joining us, welcome to the program. 14 minutes ago, a blowout jobs report, a big monster upside surprise. 272 is the number, 180 was the estimate. Two standouts here, not just the headline number, also wage growth coming in hotter than expected at 0.4% versus the estimate in our survey of 0.3% month over month. Straight away, market reaction. Equities gapping lower. Equity futures on the S&P 500 down by 0.5%, on the NASDAQ down by 0.5%, on the Russell down more than 1%. Turn the page and get to the bond market, and here's your why. Big repricing at the front end, up by 11 or 12 basis points on a 2-year, up 11 on a 10-year as well to 439.81. You have to point out, though, Lisa, when you look at these moves, this is below where we were a week ago, because we had a string of weaker than expected data going into this print, and this bond market rallied hard coming into this morning.
You know, I think that the conversation that we've been having with both Mohammed, the way he's talking about the idea that the weaker data really does point to something that is more sustainable that can't be offset from these numbers. And then Jeff saying, well, this reintroduces the debate really about, are we restrictive? This is the seesaw. And frankly, the markets are kind of tipping it in one way or the other. I mean, that's what we heard from Ellen Zentner, that basically the more enthusiastic this market gets, the harder it is to get to the Fed's goal. So it becomes this sort of chicken and egg race, you know, and this is what's making it really difficult to understand where we're at, because it's like that scientific experiment that we affect the experiment as we observe it. That's where we're at right now.
We shape the events we anticipate.
Correct.
That kind of thing. Can you just imagine Kashkari walking into the 2-day meeting next week, sort of banging the table? Told you so.
Yeah.
Don't we need to have this conversation right now?
Well, he would be right at that moment. And then there are going to be the people who believe what Mohammed El-Arian is saying, which is that if you look at the data, there is weakening coming down the pike, and you can't ignore that. It is a fraught moment. I actually think it's going to be a very difficult debate next week.
Mohammed, we know what you think they should do. Let's talk about what they will do. How is Chairman Powell going to navigate this news conference, given the information we just received this morning?
I think he's going to maintain maximum optionality. He's going to retain his data dependency mantra. And he's going to say, you know, we need more confidence. He's going to use the word confidence and patience, I suspect. And that's it. You know, John, I find it fascinating. Two things I find it fascinating. First, I think it's a shame that we've broken the record of, I think, 28 straight months of the unemployment rate below 4%. That was a nice record to have. But what I find really interesting, and Lisa referred to it and you referred to it, is that the bond market has been much more volatile on the data than the stock market. The downside surprises we had moved yields in a massive way, moved the commodity complex in a massive way, had relatively little impact on equity, and we're seeing the reverse today. And I find this absolutely fascinating, and I would be very curious to hear what Jeff has to say about, you know, this difference in actual volatility between these two segments.
Jeff, what do you make of that?
Yeah, it's a great point. And I think it's explained by this other big topic that in other contexts, it would be the only thing we're talking about, and that's the AI boom. And so you look at technology as a share of the S&P 500, it's 43% market cap. This is a different story. I think where you want to see, or where you see, or where you want to look for to see the interest rate impact is in small caps. And I think we'll see that this morning, and a much bigger outcome. And so it's numerator versus denominator. The numerator effect of technology, these incredible amounts of CapEx and cash flows is just overwhelming the denominator for that index. And you see that particularly in growth. You see it in the S&P 500 with a very high weighting. So I think that's what explains the higher volatility. You also see it in kind of macro. Look at the MOVE index. Look at interest rate volatility relative to VIX volatility. And the VIX volatility is compressed because you have the tech story. It's also compressed because you have a very low degree of cross-market correlation going on in equities right now. So there are some really important differences going on in the translation of macro data into these indices, and the micro stories going on in equities are as powerful or overwhelming the macro story of the variability that Lisa just mentioned. You know, are we too hot, are we too cold, that you see reflected in the bond markets every data print.
And certainly the macro environment is whipsawy, and we have been talking about the frustration of where to get conviction. Jeff, you really raised this point about this really questions how restrictive we actually are. From your vantage point, does this print of 272,000 new jobs being created in the month of May change your view about the balance of risks for both the Fed as well as for rates?
Well, it's not my view that really matters. I think, will the Fed change its view? And I really don't think they will. This asymmetric response that if inflation slows, if growth slows, and I think the growth picture is going to be as important, the Fed will increase its probabilities. It will want to cut rates for the reasons that Mohammed said. They're more worried about now losing the war. They won the battle on inflation. They don't want to lose the war on the soft landing. And so because of the asymmetry, I think that eases some of the market reaction, the broader market reaction, obviously not from the day reaction to today. So I don't think much has changed there. I think if they were to start talking a little bit more about the concerns about maybe we're not restrictive, if you had more growth data, they'll get the question eventually again, you know, what about hiking rates? He'll dismiss it, and I think that asymmetry is still with us, and I think that's supportive to the financial market outlook. And so I don't think there's a huge change there.
Hey, Jeff, just for the record, we care what you think. We care a lot about what you think.
Absolutely.
Thank you.
This story written yesterday by Rich Miller, our colleague here at Bloomberg. Got to share this with you because there will be some of you out there asking, do these numbers this morning overstate the strength of this economy? Are we measuring things the right way? Is this accurate? Data published Wednesday by the Bureau of Labor Statistics suggests payrolls might have grown about 60,000 less per month on average last year than the roughly 250,000 run rate derived from the agency's monthly employment report. Mike McKee, that question is going to reverberate through the weekend after that number this morning.
Yeah, it's interesting. You're going to have a lot of debate over this because Steve Stanley from Santander points out that we had basically the same situation at this time last year, and then the QCEW numbers, the ones you're referring to, were revised down, and we basically didn't have much of a significant change in payrolls overall. They don't give us the number until August. So we'll be waiting for that. It's just before Jackson Hole. So it may be that it's not as bad as these numbers suggest. But if it is, this doesn't fit with that.
It raises the question, Lisa, are we having the right conversation? It's something we have to think about.
Well, here's the thing you got to worry about. Is the Fed has to deal with the numbers that it has. And so if these numbers come in much weaker when they're revised later on, everybody's going to say, well, the Fed missed it. But they don't know.
Well, this is a reason why, and it's actually wonderful to have Mohammed on. This is a reason why he says this is one of the fatal flaws of data dependency, especially when the data is messy. And that is the moment that we are clearly in.
Mohammed, let's get to it. Do you think we are having the right conversation? Obviously, based on what you've told us over the last few weeks, you don't think we are?
No, look, I think we're having the right conversation based on the data we have. It's very difficult to have a conversation on counterfactual data. But what we are being reminded over and over again is how difficult this economy has become to understand. You know, John, go back to August 2022, the famous 8-minute speech with Payne. Go back to the Bloomberg headline of October 2022, 100% probability the US goes into recession. And then look what actually happened. If you become too data dependent and don't take longer term views, you end up risking real mistakes. And that's what I'm really worried about, John. There are some very clear secular trends going on. Jeff mentioned what's going on in AI. That's one of several secular trends that are going to be with us for a while. that we've got to incorporate and stop looking simply at the rearview mirror. You have to both look at the rearview mirror and through the windscreen.
Jeff, final word, your big takeaway?
Well, it's just clearly a big surprise, big downside surprise relative to expectations. July's door is closed, opening the door on a debate about how restrictive Fed policy really is.
Can I just ask you both your best guess for the dot plot next week? 2 or 1? 2 or 1 on that dot plot for cuts this year. Mohammed, first to you.
1.
Jeff?
Just for contrast, I'll go with 2.
Okay. Jeff Rosenberg, BlackRock, Mohammed El-Erian,
I would have
gents.
done the same, John.
Appreciate it. I know you would have, because you're trouble, Mohammed. We know that. Jeff is too. Appreciate it, gents. Thank you. Does it come down to 2 or 1 on Wednesday?
Yeah, or does anyone raise the prospect of none? I mean, honestly, are we going to start seeing a lot of no rate cut camps? Because frankly, this is supportive of them. Subhadra Rajappa actually wrote in, and she just had this great quote. She said, this number is a nod to the no cuts camp. We are quietly swimming against the tide. And that is definitely the feeling right now on Wall Street.
What do
No
you think
cuts,
the folks in the city are doing at this point?
Yeah, Apollo no cuts 24. I'm waiting for the note from Andrew to see if they throw in the towel on July. You'd have to imagine they're going to.
You've got to. You've got to figure that. July 5th is the next release. Day after the 4th of July, it's a Friday. Everybody's going to be in a bad mood anyway because they're there, so it'll be interesting to see what happens. Although, it's pretty clear, July 5th, you and I, no ties.
No ties. Did you notice that? It was so funny in the commercial break, just to share with you. No ties, Jeff and Mohammed. And I said hot labour market, right? Usually when the labour market's hot, you don't care about dressing up because you can get a job anywhere, right? Who cares about what you look like?
They were prescient, evidently.
Right? Hot labour market.
I will just say, as much as people will try to say, where is the flaw in this data because it doesn't cohere with other things, if you take it on face value, with wages coming in harder than expected, you really need to start talking about the idea that we're not that restrictive. And I think that Jeff actually made the right point. If you take it on face value and you are data dependent, how could you not be having a conversation about what kind of level of actual restraint is this Fed policy actually putting on an economy that's growing by 272,000 jobs in the month of May?
If things could change again Wednesday morning, I'll say that. Things could change again Wednesday morning when we get CPI going into the Fed. But as things stand, you'd have to imagine that going into this meeting, Neil Kashkari's got a bit of a skip in his step, right? Going into this meeting, feeling good about himself. Yeah.
Yep, talking about the potential for hikes.
Yeah, I think at least for now, at least, the Hawks have it. Coming up Monday, Troy Gajewski of FS Investments, Mike Schumacher of Wells Fargo, Sarah Hunt of Alpine Saxon Woods, and BlackRock's Amanda Lynham. Before we get there, before we get to the weekend, we've got to get through today and talk about these numbers. 272K, a big upside surprise from New York City. This was Bloomberg Surveillance.
Welcome back to another special Roland Garros update for Bloomberg TV and radio from Tennis Channel. Iga Swiatek punched her ticket into the championship match as she took out Coco Gauff for her 11th victory over the American in 12 career meetings. World number 1 hasn't dropped a set since the second round in Paris and heads into the final looking for her 3rd straight title in the French capital. And don't forget, you can watch all the action on Tennis Channel. Our daily live coverage continues Friday at 8 a.m. Eastern.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zay Poland. He did come to me and Susan O'Malley, and they said, Abe Poland says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City for our viewers worldwide, I'm Katie Greifeld. A hot job sprint sends yields up, stocks down. The countdown to the open starts right now. We begin with the big issue, and that is Jobs Day in America. So let's get straight into the number with Bloomberg's Mike McKee. And wow, this was a beat.
I saw your jaw hit the floor when this happened. It certainly is a surprise. We come in at 272,000. The forecast was for 180,000. The whisper number was only 168. So a significant beat. There is a net revision of 15,000, most of that coming last month in April, revised down from 175 to 165. The unemployment rate, another surprise, as the labor force grows, but employment falls significantly, 408,000 in the household survey, and we jump up to 4.1% unemployment rate. Average hourly earnings, also a surprise, at 4% unemployment rate, 4.1% for average hourly earnings, which was not a complete surprise because there were some calendar quirks, but it does give the Fed something to think about. Hours worked, no sign that any companies are cutting back. Now, if you do have a tinfoil hat, you might consider putting it on today. Take a look at this difference between the household survey and the establishment survey. 272 in the establishment survey and a drop of 408,000 in the household survey. People are going to question which one is more accurate. Those who think that the economy is falling apart are going to go with the blue line, and those who think the Fed maybe should be considering raising rates are going to go with the white line, and you guys can fight it out all day on various social media. Where the jobs are and aren't: service industries, 204,000. That's the one that the Fed is watching. Are we still seeing strength that might be pushing up wages there? As always, education and health lead the way, leisure and hospitality, a big rebound there, as there was in construction, and many of those jobs are lower paid. We saw a rise in lower paid jobs during the month. Temporary help, though, usually a sign of things to come, down 14,000. We'll see if it's any kind of harbinger or not. I want to point out the average hourly earnings. There was an extra couple of days that put us in the survey week in May that put us past the normal paycheck month, the 15th, the day of the 15th, and that may have added to this. When you go out by 3 digits, you can see there was a big change in the month-over-month number of about 15 basis points. So we did see wages go up significantly. Is it a problem? And then finally, I just have to tout a new feature of our ECAN option here. Call this up. You can see the breakdown of what happened with unemployment during the month, and in the month of May, much of it was additional people who were completing temporary jobs as opposed to leaving their jobs.
All right, Mike McKee, thank you so much. Let's get to Washington and Bloomberg's Joe Matthew.
Welcome to our TV and radio audiences worldwide. Welcome to the Labor Department today. We are here with the Acting Labor Secretary, Julie Su. And Secretary, it's great to see you this morning. Thank you for joining us on another Jobs Day. We've got a bit of a mixed signal here in this jobs report. More payrolls than expected and a higher unemployment rate than expected. Which survey, household or establishment, is reflecting reality?
Well, this is another very strong jobs report. I'm not going to get tired of coming here and telling you that we are continuing to experience very strong, stable, and steady growth. So it's 272,000 jobs created last month. The unemployment rate has remained at or below 4% for 30 months straight. That's still the longest since the 1960s. And at the same time, real wages, over the year are up 4.1%. So workers are doing better in an economy in which the president has said, when we focus on workers and worker well-being, we're going to do what's right for the economy and for the country.
When you look under the hood, you find that 400,000, even more than 400,000 people left the labor force in May. The participation rate is not back where it was before COVID right now. How do you explain that?
Well, so let's say, the prime age labor force participation rate remains very, very strong. And it's worth noting that, again, women's labor force participation rate hit another historic high. So last month we said it was the highest since 1948 when this data was begun to be collected. It's now a little bit higher than that even. So women continue to power our economic recovery. At the same time, we are seeing, again, strong participation. People are in the job market. People have come off the sidelines. People are looking for jobs, and they're finding them. Where there has been a little bit of a very small uptick in the unemployment rate, again, still at or below 4% for the longest stretch in decades, but has to do with young people ages 20 to 24 who are in a bit of transition, really, if we think about May, right? May is a period of transition for all of us parents with kids who graduate and maybe move and are looking for different jobs during that time.
You can tell a great story and put a great headline number on that unemployment story, as you are right now. But when you look under the hood, you do see some elements of weakness compared to the payroll survey. And I wonder, while you're happy where it is now, if you worry about where we're going to be 6 months from now, if this is a slowing job market.
Well, the payroll survey really is the gold standard when it comes to the unemployment rate, right? This is the, it's the largest by far of any data set, including the household survey, that is used. And so, again, I don't think there's any way to paint this as other than continued strong, stable, and steady growth under President Biden's leadership, and proof of his theory that if we invest in America, we can create good jobs in communities and, crowd in private investment in order to do that. And as I travel the country, I'm seeing the benefits of that.
We've talked a lot about the impact that immigration has on our job market. It can be for better or worse, depending on the trend that you're looking at. And there's an analysis from Steve Englander at Standard Chartered Bank that we looked at this week that estimates about half of the job growth since October can be attributed to undocumented migrants, that it's somewhere in the area of 109,000 a month. If the president's executive order put in place just days ago lowers the threshold, lowers the numbers of undocumented immigrants entering the country, what does that mean for the job market? Do you see numbers like that in your modeling?
I mean, I haven't seen that study. I would actually question those numbers based on what we see. Right? This is a situation where, one, we're not talking about dividing a small pie into smaller pieces. We're talking about a much bigger pie overall. So more jobs, more people in the labor market, more opportunity for all. Since the president came into office, again, we've talked about this, about 15 million jobs created. That is 15 million families, 15 million individuals who are having the benefits of a good job that might not have had that before. I would also say that it is true that there has been, immigration-based growth also, and that has been true throughout our nation's history, right? That immigrants have helped to do jobs and help fuel the economy, but the majority of this job growth that we're talking about has gone to native-born workers.
Well, talk to me about the other side of this story. and that's immigration reform. H-1B, H-2B. We spend all day talking about border security in Washington. What does our job market need in terms of attracting talent from other countries legally?
I mean, it's such an important question, right? This is why, since day one, President Biden has called for the kind of comprehensive immigration reform that would address, some of the challenges that our system has created.
What would our job market look like with that help?
What would our job market look like with...
If you got that reform.
Right. Well, so we do administer, we have in this administration increased the number of H-2B workers that have come in. We recently did a rule around H-2A workers, making sure that when migrant workers come to this country through legal means, that they're also protected, right? That they are protected for their own good, but also so that their being here doesn't take away from the good wages in those industries. So we, but the bigger picture is that there does need to be comprehensive reform. The president has called for that, and frankly, Congress needs to do its job.
There's something that I don't want to get too deep in the weeds called the birth-death model that our analysts at Bloomberg Economics are looking at that would suggest some of the companies that we've seen closing might not be reflected yet in the numbers that we saw in this monthly survey. Based on layoff announcements, corporate closures, where do we look in the middle of summer when these numbers start to emerge?
Well, we will come out every month to report the data that we have, but everything that we have seen this past month, this past year, as well as, the last year since President Biden came into office is historic job growth. More jobs created during the same time period than any president in our history, and continued low levels of unemployment. Again, historic lows. And more opportunity to come, right? The investments in the president's Investing in America agenda, many of them are still coming out. And that's why this summer I'm going across the country talking about Good Job Summer and focusing on the importance of what a good job does for families.
The Good Job Principles Summer Tour. You're like Beyonce. You're launching a national tour, and it's not a mistake. I see some of the states you're going to, like Pennsylvania and Michigan. What is your message to voters in those states?
Well, my message to working people is that we see you, we have your back, we know that you have talent and desire, and we want to create the kinds of opportunities that will allow working people to have a good job where they can be paid a living wage and live a secure life. And our message generally is that when you build a workforce that is ready, that is trained, that is skilled, that pulls the full talent of the American people, it's good for employers, it's good for our economy, and we see that time and time again in these jobs numbers.
Yeah. Getting back to the household survey, which is important to us and our viewers and listeners, the fact that it reflects agriculture, the fact that it reflects what's happening in people's households, does that not raise the level of importance of the household survey at this point when we look at that against payrolls to get a sense of not even as much where we are now, but where we're going?
I mean, I think the bigger, the answer is the payroll survey is the survey that tells us how many jobs have been created, what industries they've been created in. And again, the growth we're talking about is not just single industry, right? It has been for the entire time, but certainly this last month is no different, very, very broad-based. We saw growth in leisure and hospitality. We saw it in construction. We saw it in professional services. We saw it in healthcare. And so, there's really, the numbers don't lie. It's really, a broad-based, solid, continued growth. And I think that coveted soft landing that so many people bet against.
Well, I haven't even mentioned that yet. It's my job to ask you if we're in the soft landing. I haven't heard words like Goldilocks this morning. What's your broader 30,000-foot view on that? You're looking at your slice of the economy, that's the labor market. Is a soft landing intact?
I think so. I mean, again, it's the kind of thing where we're always vigilant about where the economy is going. But based on where we were, remember, in 2021, right? The president came into office, COVID was raging, there was no national strategy to address it, unemployment was very, very high, people didn't know if they were going to get toilet paper if they went to the supermarket. And now we have historic job growth, low levels of unemployment. I think it is the very definition of a soft landing.
You mentioned COVID. It's not the first time we've brought this up as a barometer, maybe a baseline for where we are now versus where we were before the pandemic. It's still impossible to forecast, isn't it? You see these payroll numbers blowing off the charts based on estimates not just by the government, but by Wall Street and economists who are a lot smarter than I am. When will we be able to get a handle on what comes next?
Well, I mean, I think the reality is that's why we don't look at any 1 month's numbers as over relying on them to tell a story. But the story of this economy from January 2021 until now is of steady, stable growth, shared prosperity, and more investments to come. We know that that there's more work to do. We're also seeing the lowest levels of black-white unemployment in a very long time. So it's equitable growth too, and that matters a lot.
What would a second Biden term mean for the job market?
I think we continue to deliver, right? We continue to build a strong economy. We continue to invest in American industry in a way that hasn't been done in decades. So building, restoring roads and bridges, making sure that every family who turns on the faucet gets clean drinking water, making sure that everybody breathes clean air and has access to high-speed, reliable internet. Those are the kind of infrastructure investments. We want to build the things that we invented, right? So bringing manufacturing back to the United States, I think it means, continued opportunity for the American people.
Will you still be in this building if there's a second term?
Well, I don't want to make predictions about that. I do serve at the pleasure of the president, but it has been an honor to help to deliver on that vision.
Well, I'm glad you could join us on another Jobs Day, and we'd love to meet you back here in a month.
Thank you.
Thanks for the time, as always. The Acting Secretary of Labor, Julie Su.
All right, our thanks, of course, to Joe Matthew, of course, with Acting U.S. Labor Secretary Julie Su. And let's get more reaction to today's jobs data. And joining us now, I'm pleased to say, we have Rick Reeder. He is BlackRock Chief Investment Officer of Global Fixed Income. And Rick, you take a look at the bond market right now, and the reaction is dramatic. You take a look at 10-year yields up double digits in terms of basis points. Have to ask you about the rate cut outlook. We see those bond rate cut bets being pushed out all the way to December. Where do you fall?
So, by the way, the gyrations in the bond market over the last 2 weeks of the extremes are pretty incredible. So we're taken out. By the way, this morning, pre the number, we were pricing in almost exactly 2 rate cuts for the year. It didn't give you any room. So now you're repricing it to a level that I think is more realistic. Listen, I think the Fed would still like to get a cut or two done. I don't think this is going to put more of a focus on the inflation report, and including next week. But I still think they would like to get a cut done. I still think September you target as doing that. But listen, the economy is, if you take, you have a first derivative of growth, the U.S. economy is slower. But you have to squint to see the slowdown. People have talked about, my God, this thing is falling off a cliff, we're stagflation. It's just not true. You've got a good economy that at the margin is moderating, and I think today's data is reflective thereof.
And it's a good reminder, too, that the narrative could completely change when we get next week's CPI report. But even still, you mentioned that this is a Fed that would still probably like to cut. But should we be entertaining the possibility of a hike at this point?
Negative. I think I think the Fed, I think Chair Powell was pretty clear about rate is restrictive. And I said this last week on your show and a couple other things. Listen, you're not actually cutting inflation by keeping the rate high. In fact, the dynamic that plays out, and you see it's a good article in the Wall Street Journal on this yesterday, you pump more income into the system because the people that are spending, the U.S. economy has become much more of a creditor versus debtor because you had this massive amount of money that came into the private sector from fiscal. And so you actually just get a recirculating of income when you keep the rate this high, but it really hurts lower income. So point being, to hike rates makes no intuitive sense. To actually start to bring it down to a level that's merely restrictive, we think makes sense. So do you very slowly get that rate down to a level that's restrictive? Listen, price stability is a Fed's mandate. Your 2.8 on core PCE, probably staying around there, maybe a little bit lower. But what you're starting to see very slowly, and you got to marry this to the JOLTS report, which I think is more indicative of the future. Some of these areas, job openings, we had a peak of the JOLTS report job openings of over 12 million jobs, down to 8, almost exactly 8. Things like, it's interesting today, you look at leisure, and as well, you just start seeing the bounce there. But if you look at the JOLTS report, job openings from the peak have come way, in accommodations, restaurants, retailing has come way down. So anyway, I think you got to balance it. I think you'll see the data from year-end jobs start to come off a bit. But listen, the Fed's got to see it. And so you sit on your hands a little bit, get some more data. I think that's where we are.
I don't know, Rick, you think about what we heard in the JOLTS data, what we saw from ADP, and then NFP today, kind of felt like we were talking about different countries. But in any case, I'm glad you brought us to your comments from a month ago that basically it's a cut now, not a hike, that's needed to tame inflation. And looking through your comments, it seemed like you were really talking about the wealth effect here. You think about the fact that when you look at fixed income investments, you're earning a yield here, and probably consumers and savers feel a little bit wealthier than they did in years past.
Yeah, I think people underestimate there's been a massive demographic shift. The biggest spending cohort in the economy today is people 65 and above. Think of what's happening. Those are your savers. Those are the functional creditors of the economy. And it's actually interesting when you look at the savings rate. Savings rate stays low. Why does it stay low? Because they're still getting income pumped into their coffers. So what happens is they recirculate that money. Why do you see things like entertainment, healthcare, insurance, recreation, restaurants? That inflation level stays high because you're getting this dividend into their savings. It's so the two things that have happened: one, massive shift from the public sector to the private sector in terms of them becoming net savers, and then obviously this aging cohort that's been incredible. One last thing: when the Fed kept rates really low for a long time, companies termed their debt out. Individuals, even with the mortgage rate. Why the mortgage rate doesn't really, affect us. You don't see much in the way of housing starts, so people locked in their mortgages. So what's happened is debt was termed out, so the interest effect is not that significant, and obviously you had those other two shifts. So it's a very different. People say traditionally you got to hike rates to bring down inflation. The data and the environmental ecosystem is quite different than anything we've ever seen before, where you actually cut more income into the system when you put this kind of interest rate into the system today.
And I want to get to how investors should be thinking about that. But before we move on, I want to talk about the wealth effect a little bit more. So what you're describing when it comes to fixed income investments, money market funds, a very powerful force on the economy. Do you think that it is more dramatic when it comes to the wealth effect coming from fixed income rather than the wealth effect that comes from the stock market?
Both are hugely important. Both are hugely important. So you got an increase in your net worth from obviously the wealth effect that takes place, but also the income coming in. It's actually, what you bring out, it's a combination of the two that are creating that phenomena. And listen, by the way, there's still, like you say, a huge amount of money sitting out there, money market funds, bank deposits, that is getting that income effect. So it's the two of them combined that are creating this influence, which is actually truly extraordinary. Here's the dichotomy in the economy, the paradox that I think is a problem. The people that are borrowing, low income, small business, local banks, get pressured by the excessively high interest rate. And those are the borrowers. You're seeing this in credit card charge-offs, delinquencies, auto loan delinquencies. The point that I would make is you need to, over time, get that rate down to a restrictive level, not overly restrictive, because you're pressuring a good part of the economy. And I would argue unduly, given what is that high rate today.
And well, let's talk about where the neutral rate could be, where the Fed eventually settles up, because the bond market currently pricing that in around 4%. You have the Fed probably somewhere between 2 to 3%. What's the Rick Reeder view?
So I think when the Fed starts moving, the terminal rate's coming up. So think about what happens. And by the way, the Fed can execute this by not creating a financial stability, easing of financial conditions of significance. I think what happens is you bring that short-term funds rate down, you keep the terminal rate a bit higher, and you ultimately, to me, it doesn't take much to get the funds rate down to 4.5. But then then it's questionable you're going much lower than that. We're going to be in a higher inflation environment for a period of time. So point being, I think the dynamic is, gosh, should we go to 4.5? I think so. But are you going to go further than that? Certainly in the foreseeable future, maybe not. So that's where I think, we're going. Part of why, I think you can get some steepening of the yield curve, but gosh, I don't think long rates are going very far from here. People have talked about, we're going down dramatically. I don't think so. And part of why, we've talked about it together on the show. Part of why I like creating income and fixed income. We talked about our ETF, this BINC ETF. Like if you can create, and now today, you can create close to 7% in fixed income without really stretching in terms of credit quality, in terms of emerging market debt, et cetera. That's pretty attractive for people today.
Well, Rick, let's go right there. Of course, your ETF, the ticker is BINC, of course, BINC there. And it's interesting, you take a look at your allocations, and you're pretty much more in high yield than anything else. That's about 40% of your portfolio. And I think that's pretty interesting because then you take a look at the duration, you're pretty short. It seems like credit risk is where you're more comfortable right now.
It's right. By the way, there's high yield and there's high yield. We like single B U.S. high yield. We like double B European high yield. By the way, you don't have to take the risk in triple C. I don't think we own any. I'm certain we don't own any triple C high yield. Like, why take the risk? You get plenty of yield from staying in credit quality. By the way, I would argue today's high yield, a double B high yield company, because they term their debt out, there's no maturity wall, is pretty darn close to an investment grade credit. So the point being, stay higher in high yield. Use some investment grade credit, which we are today. And yes, Katie, I think I've been doing this a long time in credit. It's as good as I've ever seen credit quality because they termed their debt out when rates were at zero. And so they're sitting on very little maturity wall in other than parts of the lev loan market. So anyway, I like being in credit. I also like securitized assets. I mean, things like AAA CLOs, because they're floating rate, because you actually get enough spread, you can create mid-sixes type of yield. And by the way, being a AAA asset, there's a lot of stuff you can do without stretching. You know, we like the better, taking a little bit of EM, but only in the highest quality parts of EM. Like, there's no reason to stretch today, to get these type of yields.
And Rick, I mean, to that point, actually, Bank of America had a note out earlier this week saying that if you take a look at double B bonds and triple B bonds, that border is getting blurrier and blurrier, to your point that this is a higher quality, high yield market. But before I let you go, I want to go back to the yield curve, because that yield curve steepener, it's broken a lot of hearts this year. It was one of the highest conviction trades coming into 2024. Just hasn't worked. And I mean, listening to you talk, it sounds like it might not work for the foreseeable future here.
So listen, I think that trade, I mean, people want to get into that trade, and then I find doing that tactically is, they're better alpha sources, quite frankly. I just find clipping income and using the front to the belly of the yield curve to clip income. Like you said, keep your duration at a moderate level and just keep clipping income. There are some exogenous things that keep the back end well pinned. Pension demand comes in, life insurance demand comes in. Listen, I think playing for the steepener, if you said to me at the margin, would you be in a steepener versus a flattener? I'd be in a steepener. Would that be my primary way to generate return in fixed income? I think there are easier ways to do it.
And 30 seconds before I let you go, what do you need to see before you go out the yield curve and increase that duration?
Well, so first of all, I mean, listen, the Treasury's going to issue an awful lot of debt out the curve. I don't find the back end that interesting at all, unless you're a pension, unless you have a long-dated liability. It's going to take a lot. But could you go out to the 7 to 10 year point? I think so. But I think we got to get on the other side. Listen, if you got a good inflation report next week, would you push would extend out a little bit? You need to see persistence of that core PCE metric, and in particularly service level inflation. You need to see that start bending down, and then you could push it out a little bit. But gosh, I would argue today, I would add more duration. We will add more duration, but more in that belly of the yield curve. And particularly days like today where you get nice backups, but I don't know, to go out the yield curve and a flat yield curve to take more volatility in your portfolio, I just don't think it's that interesting.
All right, Rick Reeder, it is always great to speak with you, especially on Jobs Day in America. Our thanks, of course, to Rick Reeder of BlackRock. Have a great weekend. Meanwhile, you take a look at these markets with just a couple minutes to go until the open, and you can see S&P 500 futures coming back a little bit. Still down, but we're only talking about 0.3%, a little bit better, too, if you take a look at the NASDAQ 100, currently off by about 0.2%. The big action is in the bond market. That 10-year Treasury yield currently higher by about 12 basis points. Now coming up, we'll speak to Morgan Stanley's Andrew Slimman on the impact of the jobs report at the opening bell next. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is the countdown to the open. I'm Katie Greifeld. We are moments away from the start of trading. You take a look at the board behind me. It's still red. The S&P 500 down about 2%, or rather 0.2% in the pre-market. Same thing if you take a look at the big tech index, but really coming back from what we saw after that blockbuster jobs print. Let's take a look at the cross-asset board right now, and you can see all of the action really in the bond market. The 10-year Treasury yield currently higher by about 12 basis points or so, a much different reaction to what we're seeing in the stock market. Meanwhile, you take a look at the FX picture. Euro USD, that pair currently camped out at 108. It's been there for quite a while, and crude moving a little bit higher right now, 0.4%. But one stock to keep an eye on at the open, of course, is GameStop. It has been a wild ride as Keith Gill plans his YouTube return, and the company announced that it would sell up to 75 million shares. Simone Foxman has more.
Yeah, Katie, all eyes were on this 12 p.m. Live stream, and that's in Eastern Time, New York. But then the company kind of getting in the way of this wild rally. We saw shares up 47%, over 47% in yesterday's trading, and it continued over 30% in the post-market, and then fell this morning in pre-market trading. We've seen those losses mostly continue. It was down almost 20% after the company first announced first quarter results. It did that early. It announced a net sales decline of 29% year on year, a loss of 12 cents a share. There aren't many analysts that actually follow this name on a regular basis, but this was higher than they anticipated. And then it announced that plan to sell 75 million shares. Mind you, it had already sold $1 billion, raised $1 billion in a share sale last month. So that's where we stand as we head into this highly anticipated YouTube presentation at noon. No one understands exactly what Keith Gill, Roaring Kitty, is going to say, but the expectation is that he owns a lot of shares, perhaps one of the top 5 owners of GameStop shares at this point. So that's what we are going to be watching today in meme stock land, Katie.
I like that you called it a presentation, because really we have no idea what's going to happen at 12 noon, but theoretically we're going to hear from the cat himself, Simone Foxman. Thank you so much. Let's turn over to earnings now, because ski operator Vail Resorts missing revenue estimates and cutting its forward guidance for the full year. Natalia Kunijevic has more.
So Vail Resorts cut its guidance, and the number came almost $30 million below what analysts had expected. So this company operates and owns mountain resorts and provides services like ski schools or golf lessons. And what's been happening quite lately with the company, there was a huge demand for travel after the pandemic, but now it's normalizing. And on top of that, last winter was warmer than expected, and it's getting more and more expensive to travel. We see that not just across low-income consumers, but high-end consumers are traveling much less. So the company posted a huge decline in sales of its ski passes. What normally happens, it starts selling ski passes from March till the beginning of the next skiing season, and the number we got today was from March till May, and that number was very disappointing for many analysts. So short-term, analysts, including Jefferies, they see challenges coming from warm winter and lower demand, but longer term, they expect that capital investments will provide some growth for the company, and it's shifting its strategy a little bit because over the past 15 years, it has been buying US ski resorts, but during the past 2 years, it bought 2 European resorts, so maybe it will provide more growth, Katie.
Yeah, we'll have to see if that actually plays out, but right now, a total wipeout when it comes to Vail Resort shares. Natalia Konijevich, thank you so much. Let's turn now to EVs because a Tesla investor suing the car maker to challenge a proxy vote on its move to Texas and reapproval of a $56 billion pay package for Elon Musk. Ed Ludlow has more, and let's talk about the pay package and, of course, that vote coming up next week. What's the expectation right now?
Hi, happy Friday.
Hi,
well,
Ed.
Tesla's up 0.4%. It had opened down 1%. This is a suit by a gentleman called Donald Ball, who holds 28,000 Tesla shares. So at $178 a share, you do the math. I'm not going to do it in real time. And he's basically arguing that in asking investors to vote to move the corporate headquarters from Delaware or incorporation from Delaware to Texas, but also the comp package, that Tesla is in breach of its corporate charter because, as the suit alleges, the corporate charter was established in Delaware. And what Tesla is saying is that they just need a technical majority in order to pass those two provisions. What the suit is arguing is that that's not the case. Under Delaware law and a charter that's established under Delaware law, you would need a 66% majority. Of course, we have the annual shareholder meeting next Thursday, 4:30 p.m. Eastern Time. I won't be here. I'll be on a beach in the Mediterranean, such is the stress of covering this company. But I'd observed that a very large number of institutional investors, and particularly retail investors, have come out in support of Elon Musk's pay package. So this suit is an interesting development, but it's just the latest twist or turn. There are those that have come out against it. I guess highest profile, the CalPERS CEO saying that as it stands, they wouldn't vote in favor of that pay provision. But interesting trading this Friday. The stock up 0.6% now, basically flat on the week. I think technically we're heading for our second weekly decline, back-to-back weekly decline for the first time since March. You're somebody that loves data. It's a stock that's down 29% year to date, but on the back of 100% gain in 2023. You know, it's a really finding a forward direction moment next week, and I'm sorry I'll be missing it.
Yeah, Ed, two things there. I cannot believe you're off next week between, of course, this vote and Apple Day, which we're going to get to in the next block. But quickly, before I let you go, when it comes to the pay package, reapproval of the pay package, what if actually the vote says no? What does Elon Musk maybe do?
Yeah, I mean, this is a factor of the suit, and it's the idea that Musk has threatened to go and take his focus on artificial intelligence elsewhere if he's not able to secure what he wants, which is its superior voting rights. It's not necessarily the pecuniary or compensation side of this. He just wants greater control to establish his AI vision for the company. And again, the suit alleges that by putting that to investors, that's wrong per the corporate charter. But many investors back him on that. Many investors come out and said, yeah, okay, if you believe this is the direction to go and you want control to do it, then we back you as well.
All right, well, pessimists might argue that his attention is already elsewhere, but Ed, I take your point there. We'll be catching up with you in just a couple of minutes. But right now, let's welcome in Morgan Stanley's Andrew Sliman for some reaction to what we learned this morning at 8:30, because I think that it surprised just about everyone, Andrew. It's interesting, though, if you take a look at the market reaction, honestly, stocks have come back a little bit. The S&P 500 still down about 0.3%, but holding up remarkably well. What do you make of that?
Look, I would make the argument that strong economy is good for equity. So I would be, on a short-term basis, I'd be buying this dip. And the reason I make that argument is simply that if you think about this year, what has driven the stock market higher is that earnings have come in stronger than expected. Earnings estimates overall cumulatively are higher than they were at the beginning of the year. So if the economy continues to say it's strong, and that's what we're getting today, that's good for earnings estimates, and that's what's driving the market. So at least as it pertains to equities, I think the Fed pushing out when they're cutting is good news.
Good news. I'm interested to hear that, because a lot of people took the fact that you had 6 rate cuts priced in at the start of this year as really a bullish rallying cry. Why is it good news that maybe this is a Fed on hold?
That's completely false. I mean, that narrative. And the reason why is when you think about to year end, okay, on December 31st, when we get to year end, where is the stock market going to be? It's going to be priced off of 2025 earnings, because that's the next 4 quarters. And that started the year, this year, at $275 a share for next year. We're now up to just below 280. If the Fed had cut 6 times, we wouldn't have gone from 275 to 280, because that would have been telling you economy weak, that's not good for earnings this year and certainly not next year. So I think the fact that if you said to me at the beginning, the Fed's not going to be able to cut 6 times because the economy is strong, I'd say, oh, that's good. We're going to have earnings. So I think that's why the 6-cut narrative, good for equities, was completely, flipped upside down. I don't think that's good news at all.
Yeah, so point taken there. And I remember I was anchoring the last week of the year, and we were talking about these 6 rate cuts. And 6 rate cuts, that seems like a recession, kind of like what you were saying. But even still, you think about the speculative fervor in this market, if you want to call it that. Of course, what we're seeing with meme stocks, I'll say it, what we're seeing with GameStop, does that give you any pause as to maybe things have gone a little bit too far?
Without a doubt. Without a doubt. Because if I think back to the previous bear market low, which was in March of 2020, we had a good year in 2020. And then 2021 was only the second year of that recovery, but boy, it was a frenzied year. We had meme stocks, we had SPAC, we had IPO, margin debt went through the roof. So we haven't seen that yet this year, but maybe the meme stocks is just the start of the speculative fervor. One thing I would point out, however, is, and I'm a long equity manager, is the number one pushback I get to equities is, why would I buy equities when I could be 5%, 6% in money markets? And that is, my simple response is because the equities return historically double that. But when you think about that, people don't think that way when you've had a multi-year bull market, because their expectations are double-digit returns. You think that way when you're worried about losing money. And that usually is in the early stages of, bull markets are born on pessimism, they grow on skepticism. That concept of, I like 5% risk-free better, that's the pessimism, skepticism stage, not the, mature on optimism, die on euphoria stage.
Yeah, it feels like for every active manager, whether you're in equities, fixed income, whatever you have it, cash is the stiffest competitor right now, even though, to your point, I mean, stocks usually return double that. But I want to talk about some specific names here, because you write in your notes that you take a look at NVIDIA. That rally makes sense if you look at the fundamentals, but it's time to look beyond that. And you name a few names. You have Amazon, Google there, and then you have CRH. And that caught my eye because that's a building materials supplier, not exactly a big tech company there, Andrew.
Sure. So the overall thesis, the commonality to all those stocks, however, is that if we look from a factor standpoint, what is the best factor year to date? certainly momentum, but it's also earnings revisions. So in other words, companies that are delivering on earnings fundamentally are doing the best. And that's a very healthy sign of a stock market. You want companies that are, raising guidance to do the best. Well, CRH is an Irish cement company, but they happen to do a very high portion of their business in the United States, which is why they are in the process of relisting their shares in the U.S. And the reason why their business is doing so well is because we have all this infrastructure spending going on. So their business is very strong through fiscal policy spending in the U.S., but the kicker is it is going to be relisted in the United States, and could it get a revaluation upgrade that would be more consistent with basic material companies listed here in the U.S.
I do think that is a fascinating trend. Actually, earlier this week, we were talking about how you have activist investors really pushing London-listed companies to list in the U.S. for pretty much exactly that reason. But I only have about a minute or so left with you. So really quickly, I do want to point out that you do see a bigger drawdown at some point this summer. What's going to drive that?
Well, if you think about what, again, going back to what's worked this year, it's been earnings have been stronger and PEs have lifted. So the very bearish scenario is a whiff of stagflation, because stag means, economy slowing, and maybe that 280 number for next year is too high, and inflation is higher rates, which means PEs are too high. So that's the double whammy that would hurt equities. I don't think that will be the case this year, but I'm very wary of the fact they're going in the summer, the market's strong, and could we get maybe some CPI prints that are too strong, or we get some weak economic data, certainly not today. That would be the scenario where you get a more of a substantial cut than pullback in the market than we saw March, April. And, we tend to get 10, 15% pullbacks once every, year to 18 months. And the last 10% pullback was in September of last year. So we're probably due at some point for that. I just get a little bit more nervous as we go into post second quarter earnings in late July.
Well, I'm sad to say we have to leave it there. Really enjoyed this conversation. Have a great weekend. Our thanks, of course, to Andrew Sliman. He is Morgan Stanley Investment Management Senior Portfolio Manager and Managing Director. Now coming up, tech stocks flying high.
Tech is kind of in a bubble of itself in terms of its profitability, right? Its earnings. So that's a great story, and I'm not entirely sure we're close to that popping.
We'll have more on tech as investors await an update on Apple's AI strategy. This is Bloomberg.
The names that move markets are on Bloomberg.
With all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. Look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Is kind of in a bubble of itself in terms of its profitability, right? Its earnings. So that's a great story, and I'm not entirely sure we're close to that popping. What is really interesting to me is that, I mean, this AI excitement is capturing imagination from companies all over the spectrum.
Well, nearly 2 years after the artificial intelligence frenzy started, Apple is preparing to lay out its vision for the technology. The company will introduce its long-awaited push into AI at its annual Worldwide Developers Conference on Monday. Joining us now for a preview is Ed Ludlow. He is the co-host of Bloomberg Technology in San Francisco. Of course, you won't actually be here. You'll be on a beach, but tell us what we should be expecting.
Well, and I regret that I won't be at WWDC. I got my invite, and I really and I immediately regretted it because there's a huge frustration with Apple that they haven't shown their hand yet in what is consumer-facing AI and iOS. What Bloomberg's Mark Gurman is reporting is that they're going to show us something called Apple Intelligence, or AI, and that it's underpinned by their own work and by a partnership which they should announce, according to Mark's reporting, with OpenAI. And the idea is not to have some kind of dedicated standalone chatbot, although there is a sense that we will see something like that, but basically improve the existing suite of apps that are available on iOS and macOS using artificial intelligence. And, you know, Mark is often right to the letter at these events in terms of his preview and his reporting.
And is this enough to re-energize the stock? You talk about that narrative that Apple is behind in AI, and that has certainly dragged down the stock.
Yeah.
I mean, it's pretty lifeless year to date, only up about 1.3%, Ed.
I know that you caught my column the other day, but the basic premise of it is, if you look at the third-party data, overall the smartphone market's going to recover this year and have around 4% growth across smartphones. But Apple's level of growth is much lower. The forecasts are less than 1%. And what's happening is there's evidence in China consumers are already buying the latest Gen 15 Pros, and that they intend to keep hold of those smartphone systems for longer. Higher price point, they're fine. So it's a really big question in Apple's case in particular, because what Mark's reporting tells us is that these new AI tools, you have to have iPhone 15 generation or later, so whatever the devices they release later this year, in order to get access to the AI tools and AI suite. Will that spur an upgrade cycle? There are those that think they will, and there are those that think that it won't, because consumers can be price sensitive. And they basically look at the AI tools, and there's a large body of consumers out there that say, I don't yet understand how I'm supposed to use generative AI on my phone every day in a way that profoundly changes my life.
Ed, before you sail away, just really quickly, we should talk about NVIDIA and, of course, that
Sure.
upcoming stock split. Right now, NVIDIA shares will cost you close to $1,200. After they split the stock, will that really invite retail in?
It really will, and a stock split simply works this way. Fantastic explanation in the quick take. It's like swapping a $10 bill for 10 singles. You know, it lowers the barrier to entry, and there is intense retail interest in this name. Go on social media and search for NVIDIA and see what's being talked about. Look on Reddit, look on StockTwits. It's just been an astonishing run, and it does not have a dilutory effect. So let's see how it goes. Look at comparisons. Tesla did a stock split. How did that go for Tesla? It went pretty well in terms of the immediate upward trend in the days and months that followed. So definitely one that you guys can be watching for next week.
Ed, we will certainly miss you next week. Have a great vacation. Our thanks, of course, to Ed Ludlow in San Francisco. And for some of the sector price action this morning, let's get to Bloomberg's Simone Foxman.
Yeah, Katie, a narrow majority of sectors are in the red today when we look across the S&P 500. Of course, real estate taking the most hit after that strong jobs data and the prospect, of course, of higher for longer rates. But when we look back over what the past week has been, we're looking at an S&P that is likely to see its sixth out of the last 7 week of gains, and that's mainly on the back of what's happened in info technology. Hewlett-Packard and NVIDIA leading here, but that's also had 6 of its past 7 weeks in the green. Communication services, as well as discretionary. It's also been a strong week for discretionary with Norwegian Cruise Lines and Carnival, but comm services there, our second best performer. To the downside, you see energy and utilities there, but when you look down into the details of utilities, it's really all about what's happening in the energy space. We saw OPEC Plus announce that it was going to gradually wind down production cuts from October. We saw Brent fall below $80 a barrel, hitting a 4-month low on Monday. That's where the real negativity is in this market, Katie.
All right, Simone Foxman, thank you so much. Coming up, the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
For the trading diary, what you need to be watching through next week. U.S. April wholesale inventories at the top of the next hour. And then Monday, the Apple Worldwide Developers Conference begins. Wednesday is CPI data and the Fed rate decision. And then on Friday, finally, we get the UMich consumer sentiment data. So a lot to look forward to, a huge week ahead. But this was the countdown to the open. I'm Katie Greifeld, and this is Bloomberg.
the linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast. It is a busy day, jobs day, really strong jobs number. We're going to break that down going forward. Coming up in just moments, President Biden will deliver a speech at Normandy in France in commemoration of the 80th anniversary of D-Day. I just saw a visual of Marine One flying in over Normandy Beach, so that was a very cool visual. So we'll bring that to you in just moments when that happens. We're also going to check on Vince Signorella, Bloomberg Market Watch, get a sense of what's happening with these markets given this really strong jobs report. David Dietz is going to join us, Senior Investment Strategist at PPAC Private Wealth. And Joni Biley, Chief Workforce Analyst at EmployBridge. She's in touch with this labor market. Who's doing all the hiring out there, and where are these folks coming from? So Alex Steele and I, we're going to break that down for you coming up in the next 2 hours. But first, let's go to Lisa Mateo. She's still here. We'll get a Bloomberg Business Flash. Lisa, we can't get rid of you.
I know. You're stuck with me. Market Drivers brought to you by Interactive Brokers Bond Marketplace. Access their vast selection, over 1 million global fixed income securities with no markups or built-in spreads and low transparent commissions. Learn more at ibkr.com/bonds. All right, markets taking a hit after the government's May employment report. It showed job growth exceeded expectations. Wages were hot. It's even pushed Citi to change its first Fed rate cut forecast to September from July. Let's get to the data. We had non-farm payrolls advanced 272,000 last month, smashed expectations that were for 180,000. The unemployment rate increased to 4% from 3.9%. We had average hourly earnings climb to 0.4% from April and 4.1% from a year ago. We're not done yet. We have more data coming in at this hour. April wholesale wholesale inventories month over month. The survey was for 0.2%, actual coming in at 0.1%. And then April wholesale trade sales month over month. That survey was for 0.5%, coming in at 0.1% as well. All that said, we have the NASDAQ down 0.2% at 17,138. The Dow down. Dow is little change, down 11 points at 38,875. And we have the S&P 500, little change, down 2 points at 5,350. Also want to check in with GameStop shares. They're down 18% right now. The company said it's going to sell up to 75 million additional shares. And this happening on the same day Roaring Kitty returns to YouTube. That is your Bloomberg Business Flash.
Guys, I don't know why this wasn't the lead. Job schmob. Roaring Kitty's coming back, man.
On YouTube at 12 noon, right?
12 noon, yeah.
Well, so we're trying to figure out this $75 million deal, and I got some help from a reader, Jeff in Atlanta, kind of wrote in, and GME is going to do the deal. It's what's called an at-the-market offering, which is typically the selling agent, in this case, I believe it's Jefferies, will just sell into the normal trading over a period of time and selling shares on behalf of the company, and that's as opposed to a standard get all 75 million shares out at one offering.
Oh, interesting.
So this will be done over time
to help the any sort of dilution on that end.
So thank you, Jeff.
It'll be really fun to see what I mean. There's so much hype around this. It's going to be really fun, and earnings were terrible, so that's what also makes it more fun as well. Vincent Signorella, Bloomberg macro strategist, is standing by. Former FX trader who now is going to talk about GameStop. We're halted right now in trading when it comes to GameStop. The trading pause, obviously volatility. The last tick, though, was down almost 19%. Vince, what do you think is going to happen at noon?
No, it's going to be really interesting what he says. I mean, he's basically probably going to lay out his position once again, which should show that he's still holding his entire position, that he hasn't sold anything. I think what would be interesting to see if he's added to that position in options since the last jump. I know he said something about being long calls. I think it was at 20 or 21. Stocks is now halted at 37 and change. Did he step back in and buy some more calls before the last jump? You've got to believe he's going to be talking it up. He's never altered his position, never said anything negative about the company or that he had any intention of getting out of it. I think the interesting thing for GameStop at this point now is they've got a chunk of cash. What are they going to do with it? Are they going to invest in a business that
Stay
actually
alive?
makes? Yeah, I mean, are they going to invest in businesses that make money and justify the potential for the stock, or are they going to double down on what is realistically a failed model? So, I mean, clearly it's going to get a lot of attention at noon. We'll see where it goes from there.
Hey, Vince, on the broader markets here trading today, the S&Ps. We traded off initially on the open here on the back of that stronger than expected payrolls data. We're kind of fighting back here. The S&P is only off about 4 or 5 points here. What do you make about how the market's digesting what we saw from the labor market?
It's interesting. What's going around the market this morning among traders are two things. There's the household survey of employment, and then there's the BLS non-farm payroll change. And there looks like about I would say about 5 million difference in the numbers, that the household survey is showing lower employment by about 5 million. And traders have gotten a hold of that, and they're basically telling themselves they're not believing the BLS numbers, and that employment's a lot softer than it really is. And I think that's what's driving this huge bounce off the lows that we saw after the number was out. As I take a quick glance, S&P cash is down only 5 now. So participants are basically talking themselves into a situation where they're not buying the numbers.
Hey, Vince, good question, though. I heard this household survey showed a 408,000 drop in jobs. 5 million, where does that fit into it?
So this is the total jobs growth over time.
Ah, okay.
Yeah, not a 1 month thing. Sorry, I should have been clear on that.
Which would be significantly weaker, hence the move now in the equity market, et cetera.
Correct, and as we speak, Dow's just gone flat on the day, a little changed. So that's where the traders are looking at, is that they're just not buying the numbers. Whether they're right or wrong is another story, but as can't stand in front of the bus. Right now, the markets believe they're right, and and they're taking
they're taking equities off the low. The interesting thing is the fixed income market is totally buying it. Yields are highs. You know, and the fixed income guys are smarter than the equity guys. Sorry, fellas.
Whoa.
And I usually go with them, and it's over 40 years it served me well. So I'm not changing my tune anytime soon.
So Vince, do you think? How about the narrative that all rate cuts are off in 2024? How do you think about that?
I mean, I've been saying that all along. You know, you look at this data, you look at jobs, you look at how sticky inflation is, you look at overall growth, earnings for stocks. I mean, when has the Fed ever cut rates when things are really, you know, chugging along? You've got this dynamic where fiscal policies added so much stimulus and have been stepping on the gas pedal and pumping up economic growth, and the Fed with monetary policy trying to slow things down. Realistically, it's the wrong tool. You can't treat fiscal spending with monetary policy all by itself. There needs to be some sort of agreement within both. And right now, Powell's trying to basically, he's using a sledgehammer to drive a nail. He can't lower rates. If he lowers rates, he's just going to add to the inflation scenario, and it's going to make things worse.
Yeah.
I mean, you know, there's just as much of a chance that over the next 12 months, we see inflation trend back up to where the Fed funds effective rate is versus the Fed needing to lower the Fed funds rate to be where inflation is now. It's not where things are now that we should be looking at. It's where we think rates or things are going to be 6 to 12 months from now. And I'm in the Jamie Dimon camp. I think inflation is going to run hot, and we're going to see rates a lot higher over the next few years.
And to be fair, you've been saying this for a while. Vince Signorella, really appreciate that. Bloomberg macro strategist joining us on his take. For those of you following, GameStop is now trading again down 20%. Let's get more on the jobs data here. Joni Biley is chief workforce analyst over at EmployBridge. EmployBridge is the largest industrial staffing firm in the United States. It's great to see you, Joni. We love having you every jobs day to get the perspective. What was your take on the numbers?
Well, certainly a lot stronger than I expected to see, as many of us were surprised by the big number. But, you know, overall, I think, just as your last guest, Vince, was saying, you know, there is a little bit of a disconnect between the establishment survey and the household survey. You know, so overall, looking at the job growth, you know, again, we've talked about this in the past. We're seeing some strong growth, certainly coming from the healthcare sector, the government sector, leisure and hospitality. But in this report, we really did see that the establishment survey had many sectors across the board adding jobs. And I was very happy to see that the professional and business service sector kind of bounced back because that had been very weak. So we're seeing more of those white collar professional jobs come back, specifically in the technical and scientific area.
Hey, Joni, I'd love to get your thoughts on just kind of the impact that immigration, both legal and more importantly, illegal immigration, because that's where the numbers are, how the immigrants are impacting the labor market.
Well, you know, certainly we're seeing immigration overall. You know, if you look at even, you know, the past 10 to 15 years, we're seeing an increasing percentage of our overall labor force, you know, from foreign-born workers. And that is projected to certainly continue. And it's actually helping the overall job market. So that, of course, is specific to the documented workers. You know, if we look at illegal immigration, you know, the government is certainly trying to work with the different states to get people documented so they can get to work. What we are seeing, you know, I know in particular in New York, you know, there's a tremendous amount of processing for these workers to get them documented and then to get them to work. But most of them will be looking for those lower level jobs that don't really require as much, you know, skills and experience. And unfortunately, there's not a ton of those jobs out there. So that could have a big impact on unemployment in the future.
So I guess if we were to read between all of the lines, And if you're an economist looking at the data, what is your read? Like, are we as strong as the numbers say? Some survey say something different. What do you believe? Like, what's your read on the ground?
So, I don't know if many people would like my answer, but I actually think that this headline number is a bit misleading. I don't believe the job market is as strong as the establishment survey is saying. I actually think the numbers in the household survey are a bit more accurate. We are seeing unemployment tick up for the first time. We saw a 4 in front of the number. Yep. We also saw that, not only are we seeing unemployment go up, but people are leaving the labor force and opting out of the labor force. We saw some big numbers there. And I'm just not, on the front lines, I have to tell you, in, Employee Bridge, as you mentioned, we focus on supply chain. We are certainly seeing more people looking for work. And unfortunately, there are less jobs to place them in. So I'm not saying it's a terrible job market. I mean, there are still jobs out there, but it certainly is a challenging and tough job market.
How about for recent college graduates? I mean, it's that time of year when
you asking for a friend?
No, yes, exactly, asking for a friend. So, how about what's that environment look like?
Yeah, I worry about recent college graduates. There's less opportunities for them. We're seeing that if you look at the overall JOLTS, job data, we're seeing a decline. We're down to 8 million, job openings out there. So less opportunities for them this year, even than last year. I will say, though, if they're going into healthcare, there's a tremendous amount of job opportunities in the healthcare sector, all different fields, all different types of positions.
That's interesting.
That is one of the strongest areas. So scientific, healthcare continues to remain strong. But, we're seeing a lot less in the financial sector, consulting, even software has declined. That used to be such a hot skill. It still is a hot skill, but less jobs available today than last year or the year prior.
So based on that, what are the wages like then in the healthcare sector? Is that need for talent or just humans reflected in wages also? Or are we still looking at like $8 people to get paid to take care of you in your home, which is not a nice proposition for anybody?
Wages have gone up significantly and almost doubled from the numbers that you've quoted. So yeah, we've seen, certainly since the pandemic, we've seen a lot of movement in wages across the board, all sectors. Logistics, manufacturing, but particular in healthcare, they were some of the strongest wage gains in 21 and 22 and 23. But I would say right now we're seeing a little bit more of stabilization. I'm not expecting big wage gains moving forward. I think you'll see it just kind of stabilize. But the wages have improved a lot over the last few years.
Joni, what are your clients, your corporate clients, saying about kind of their policies for work from home, hybrid, all that kind of stuff? Where have we kind of settled out on that whole thing?
Yeah, that is such a hot topic. It's a great question. Certainly, there are many jobs that it's not an option, right? Like the logistics, manufacturing.
Oh, we know, Joni.
Yeah. Right, you do know. For you have to be there. So there's many jobs that really require you to be in the office or be on site. But employers that have kind of taken the strategy of offering more flexibility where they can, because they know that workers want that. Workers want flexibility in their schedules. They don't mind going into the office, but maybe having like a hybrid schedule is like the best, where they still get to collaborate with their, coworkers, and then still have some flexibility maybe to work from home for a few days. So that's where I see kind of the trend is these hybrid schedules. But for many people, that's not an option, and you kind of have to come back to the office.
All right, Joni, we really appreciate you. It's such great insight. Joni Biley, Chief Workforce Analyst at EmployBridge. Again, they hire a lot of industrial employees. They really have a pulse on what's happening within the U.S. Thank you so much for joining us. So it's interesting. It feels like it's a have and a have not.
Yep.
But the market's reaction is also quite interesting. You know, Citi changed its cut forecast in September from July. JP Morgan hasn't done so yet that I've seen, so they're the last holdout. So we'll wait to hear from Michael Ferroli. He's working on it, I guess. Coming up, we're going to talk to David Deeds. He's Senior Investment Strategist at PPAC Private Wealth Management. We'll ask him about the surprise reaction to jobs report when you have basically stocks now pretty much flat on the day despite that sell-off within the bond market. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Little movement in stocks right now. This is after a blockbuster U.S. jobs report made traders kind of dial back their expectations for interest rate cuts from the Fed. So we have the NASDAQ down about 0.1% or 32 points. We have the Dow up about 0.1%, 71 points. S&P 500 little changed and at 5,352. Want to dig a little bit deeper? If you go into the IMAP function of your terminal, the 11 major industry groups, the biggest drag, well, that's coming from real estate. We click on, we see real estate and management development. Then we see real estate services. Finally, at the top is CoStar Group, and that's followed by CBRE Group. Over to the bond market, we have the 2-year yield, 4.85%. That's up 12 basis points. We have the 10-year yield at 4.41%, and that's up 12 basis points as well. Want to check in with shares of Taiwan Semiconductor Manufacturing. They're up more than 1%. They produce those chips for NVIDIA, for Apple. May sales rose 30%. That was thanks to strong demand for AI and a recovery in some consumer electronics. And we know today was Jobs Day, but Paul and Alex, did you also know it's National Donut Day? Yes.
I did not know
Freebies
that. I don't
from
like
Dunkin' and Krispy Kreme.
I know. It's my one weird.
I know. I wouldn't.
It's my one weird thing. That's not
She
true. It's
doesn't do
one of my
donuts.
many weird things. I love sugar, but the donuts, I don't
Can't
know.
do it. Yeah.
Just a donut in general?
I just don't like donuts.
Wow.
Like I like
Not even a
cookies.
munchkin? Not a tiny one?
They really don't. There's something about the amount of dough maybe within the donut, but like I like every other kind of treat. Like Lisa probably says no donuts because she's super fit and goes to lift weights. I say no because I don't like them.
You don't like the taste.
Yeah, I know. I'm very strange. The things you learn. Lisa, thanks very much.
You got it.
I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in finance and business through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries around the world. We also take you outside Bloomberg Intelligence to get the read on the market and investment. And what do you do when you have a day like today? David Dietz is Senior Investment Strategist at PPAC Private, and he joins us now. So clearly we're looking at a market reaction from the jobs that now we're looking at flat equities despite the bond sell-off. What do you think about this market right now?
Sure. So absolutely. We saw basically a divergent jobs report. And I think as we're looking at the market right now, it's really better for the U.S. worker, better for stocks than it is for fixed income. On the positive side, of course, more jobs were created than expected. And ultimately, as we know, 70% of that economy is a consumer. Not only are more jobs being created, but we saw a nice tick up in terms of wage growth in the last month. Indeed, positive signs in terms of real wage growth. And so that's all good for spending. That's good for corporate profits. Therefore, that's better than you would think for stocks. And I think that's why stocks are shaking off some initial weakness there. Having said that, from fixed income point of view, it's not a positive because, of course, it continues the narrative that inflation is sticky. Remember, wages are such an important part of the overall inflation picture. This 4.1% year over year. Our target is 2%. So that's not acceptable if you're a fixed income trader. That's not acceptable for the Fed. And so that's why we're seeing bonds sell off, stocks get back on their feet.
David, if there's some that are suggesting that this jobs report maybe even pushes out a rate cut till next year. If that's in fact the case, can stocks work in that environment?
Well, so, at the end of the day, as long as interest rates or the Fed doesn't hike, I think we're all right with stocks. I mean, at the end of the day, you're buying stocks for earnings. And we just saw great earnings report in Q1. At the end of the quarter, the reports came in almost double than what had been expected. And we see that trend continuing for the rest of the year. So right now, Fed Fund futures, quite frankly, say is a coin toss for what we see in September. The real debate is now, are we going to get 1 or are we going to get 2 rate cuts? From an investor's point of view, we urge our clients not to overreact to just one metric. I mean, jobs are great, but, we're talking about what happened last month in stocks, and stock investors should be focused on what's the outlook for the next 6 to 12 months. And of course, when it comes time to the Fed making a decision in September, we're going to have several more months of data under our belt. From a stock investor, the worst situation is a recession. And of course, there is really no evidence in the jobs report today to suggest that the overall economy was weakening.
So what's your top sector pick then, based on all that? for the 6 to 12 month horizon?
We like everything other than those top 3 stocks, which we're urging our clients to lighten up on, which would be NVIDIA, Microsoft, and Apple.
And is that just a valuation call, though?
Absolutely.
Okay.
So small caps, of course, if you strip out 2 small caps in the Russell 2000 that are very much pushed forward because of the AI hype, Russell 2000 is down for the year. Historically, if you look long term, small stocks have outperformed large caps. There's more room to grow. We think they're very much out of favor. We would just go with like an ETF that takes an index approach to the Russell 2000. We think that might be the way to go. The only reason where all bets are off is if you see a very hard landing in the economy. But the fact of the matter is we have still a Fed foot underneath us. So if we still see weakening, if we do see further weakening in the economy, that Fed will rush to the rescue. So we think that the small caps might be an area to take some of your winnings from those Mag 7, put them into the smaller fry.
Hey, David, a lot of folks are suggesting if you want to get some value, that perhaps international is a way to go, less tech weighting in some of the European indexes, for example. How do you think about international?
Yeah, we think that makes a whole lot of sense. The dividend yields, for example, over in the continent are almost double what they are here. Valuations are much lower, yet their interest rates are even lower than they are here. And so the difference between what you get in fixed income and what you can get in terms of earnings yields and dividends on stocks, much greater. We think that's a nice opportunity. Of course, Japan has come back to where it was in the 1980s. And of course, the real sleeper could be China, which is, at close to a 4 to 5 year low here. But we just saw a big tick up in exports coming from China. Remember, China's doing almost the exact opposite of what our Fed's doing. Here we have restrictive policies, at least on the monetary side. While in China, they're trying to press the accelerator down to lift the economy out of their kind of pandemic and post-pandemic melees. And so I think that could be a real tailwind there. They could have some of the best technology in the world, but their tech companies are trading at about half the valuation of what U.S. tech companies are trading at.
What's interesting, too, you like real estate, and Moody's said at least 6 U.S. regional banks have a substantial exposure to commercial real estate loans, and they're at risk of having their debt ratings downgraded. What do you like in real estate? What do you not like? And how do you kind of avoid this kind of headline?
Yeah, absolutely. So in terms of real estate, what we're looking at is what has now already reflected the concerns there. So let me give you an example by virtue of one stock we like, Boston Properties. There they have the commercial real estate exposure, but they're limited themselves to the 6 cities in America where people still want to go there. Your New York's, Boston's, Washington's, the high-end and then they have the high-end properties there. The stock is down by 2/3 of where it was. So obviously it's reflected a lot of damage there, but because their free cash flow has stayed strong, they have never cut that dividend. Now you got a 6.2% dividend. So, at the end of the day, I don't think everyone loves commercial real estate. No one will ever go back to the office. It's going to be somewhere in between. So we're looking at those high quality landlords that are publicly traded where the prices have now reflected some bad news. And sometimes you do well by buying when things aren't rosy, and then waiting for the situation to turn around.
David, how about financials? People are still, I think, a little leery about some of the banks in particular.
Yeah, certainly that's what we heard from Moody's. I'm not sure it's new news that some of their debt is on credit watch for weakness in terms of commercial properties. A lot of that, of course, has been reflected in the stock prices. At the end of the day, I do think that there is a strong policy coming from Washington to make sure that this banking system stays strong. Remember, that's the lifeline for a lot of smaller businesses in Main Street, USA, that can't tap publicly traded markets directly. And so I think if we want to, grow this economy and keep Main Street employed, we're going to have to make sure that those smaller banks get the lifelines they need. So that's going to be one reason why, of course, the Fed is going to be probably more dovish than the inflation statistics might otherwise warrant.
And just to wrap up, you also like 3M. I'm kind of obsessed with 3M. They're still a big conglomerate. They're changing CEOs, and they've really just like stuck in and said, like, we're not spinning stuff off. Like, yes, they make the back of Post-its, that sticky stuff, but that sticky stuff goes everywhere in the world. Why do you like 3M?
Yeah, so this echoes General Electric, where you have an industrial conglomerate, which is way out of favor. They have many different divisions. They were perhaps undermanaged, and of course, they had all sorts of litigation woes. Now they've got a new man in there, Mr. Brown. They've already spun off one of their divisions, Solventum. The stock is trading at a big discount to the market and way off where it was. We think that if the U.S. dollar softens a little bit because they're such a big international trader, that will benefit them. Of course, you know, people talk about innovation. 6 cents of every dollar that they generate goes back into research and development. They're coming up with all sorts of patents. So we think that, you know, here is a situation just like what happened in GE. New management rationalize things, perhaps do some corporate restructuring, and you could see a stock price that could outpace the S&P 500 going forward. And of course, the dividend is still much higher than the S&P 500.
All right, David, thank you so much for joining us. Always appreciate getting a few minutes of your time. David Dietz, Managing Principal at PPAC Private. We're awaiting comments from President Biden from Normandy in moments, and when he does speak, we'll bring that to you. In the meantime, with our news in New York City.
Thank you very much, Paul, Alex, and Lisa. President Joe Biden told Ukrainian President Volodymyr Zelensky that he was sorry that his war-torn country got caught up in American politics, pledging to stand by the Ukrainian people. Biden says the 6-month wait for funding, including munitions, was blamed on a paralyzed U.S. Congress, ultimately allowing battlefield gains for Russia.
The way you stood and holding on in Kharkiv, and you've proven once again the people of Ukraine cannot and will never be overtaken.
Meanwhile, President Biden will deliver a speech at Pointe du Hoc in France today. We'll bring you that speech live. A key section of the U.S. military-built pier designed to carry badly needed aid into Gaza by boat has been reconnected to the Gaza beach following storm damage repairs. U.S. Central Command says aid will begin to flow soon. The section that connects to the beach, the causeway, was rebuilt nearly 2 weeks after heavy storms damaged it and abruptly halted what had already been a troubled delivery route. The widow of Hunter Biden's brother, Beau, has been on the stand in his gun charges trial. Hallie Biden testified about the gun at the center of the case and Hunter's drug problem. After Beau's death, Hallie and Hunter had a romantic relationship, and their texts became evidence. President Biden's son, at one point, weeks after the gun purchase, wrote to her, "I am a liar and a thief and a blamer and user, and I am delusional and an addict." Prosecutors say that proves Hunter lied on the federal form for gun purchases where he denied abusing drugs. It will be the end of an era with Pat Sajak's final episode of Wheel of Fortune. Tonight's broadcast ends his 41-run year one host, hosting the game show. Global news, 24 hours a day.